Petróleos Mexicanos, Pemex. And in 2025, Pemex will be paying more in interest and in debt than it will be producing, and that will never change for the rest of its life. And that tells you everything you need to know. And it's the largest issuer in EM high-yield debt. So, yeah.
I imagine that you're not positive then on that name. Is that what I'm hearing for you?
Only if AMLO and Mexico come in and bail it out.
Bail it out.
You know, we're in a good place.
Let's talk about oil. Oil is sliding in reaction to Israel's new offensive in Gaza. Markets responding to the lack of a significant response from Iran or proxy groups, easing fears that crude supplies will be interrupted. Over the weekend, the U.S. and Iran traded warnings, including National Security Advisor Jake Sullivan, who said there was still an elevated risk of a spillover. I look at oil prices every 10 minutes to say, okay, now are they sort of perking up? And Damien, from your perspective, do you feel like the headlines that you read correlate to the price of oil? I mean, basically, does it make sense to you that prices would be coming down?
You know, no, it doesn't, because what's really different this time around is commodity currency correlations, right? I'm thinking, like you mentioned, like Noki, right? Norges Bank this week, Colombia. You know, a lot of the oil producers, their currencies in years past have really correlated well with commodity prices and with oil, and we're just not seeing that this time around. So I don't necessarily believe you're seeing a real fundamental link between the price of oil and valuations in the market.
Well, and you have to wonder how much of it is the demand side then. Is oil actually behaving because the expectation is that this acceleration in yields will actually tip the world into some sort of deeper recession? I mean, we've sort of pushed off the recession risk conversation again, and that concerns me, because maybe what oil is telling you is, yes, supply is constrained based upon what's happening in the Middle East, but if oil is not going up, it might be because demand expectations are actually deteriorating.
Really interesting. So otherwise you would see a pop, but
right.
Just there isn't necessarily that kind of economic activity. Giving us some guidance about what they're seeing. It is a major week for global central banks and the less major ones that Damien will tell us about. But rate decisions we're getting this week from the Bank of Japan tomorrow, the Bank of England and Federal Reserve are also all due. Investors also looking to the Treasury's quarterly refunding announcement on Wednesday. That's going to set the stage for just how much the U.S. has to borrow and just whether we can absolutely absorb it. And then we'll get the U.S. labor market report with a jobs report on Friday, including a slew of other labor market data throughout the week. Andrew Sheets, global head of credit research at Morgan Stanley, is going to be on tenterhooks, parsing through all of this. What's most important for you this week?
Thanks. So I think several things are important. I think that confirming that the Fed is pausing, and we do think that the Fed will not raise rates, and that can kind of further reinforce the idea that they are done raising rates for this rate cycle, which we think is important for generating and stabilizing bonds. And I think the earnings season remains very important. I mean, again, you had this kind of interesting dynamic where so far the underlying reported earnings are pretty decent, but the guidance has been disappointing. The market's reaction to that has generally been to punish misses pretty severely. And we've seen quite a bit of idiosyncratic risk coming out of earnings, single stock risk, which also matters. So those are two things that are at the top of our list.
You also mentioned at the top of your list that fiscal policy is key. Across the U.S., across Europe, across China, fiscal policy is playing an elevated role in market dynamics this year. Tell us about your views on fiscal policy.
So I do think the fiscal story is a really interesting one that affects the U.S., it affects Europe, it affects China. And so, we focus on it in a couple of ways. I mean, my colleague Chetanaya, who's our head of Asia economics, it's just some great charts that show just how much fiscal policy in China and the U.S. have diverged, where China's been tightening fiscal policy while the U.S. has been loosening it. We do think that in order to get more bullish on China, we do need to see a larger response, a larger fiscal response than what we've seen so far. In the U.S., I think the real key is how much can the states pick up the slack on the fiscal response side. I think there's a lot of focus, a lot of right focus on, we have these large deficits, these unusually large deficits in the U.S. relative to the strength of the economy. But if you go below the surface, the state and municipality spending actually holds up pretty well on our forecast over the next 12 months. And that keeps, we think, the U.S. economy out of recession and stable even as federal spending pulls back a bit. But I think that's also really important, and really important of how you can get a soft landing even with so much fiscal support from the federal government in the rearview mirror.
And then how does this fiscal landscape actually impact your corporate credit strategy? I mean, obviously, as an equity investor, we're sort of engaged in this conversation somewhat, and there is a concern in the equity universe that some crowding out may occur as a result of these extraordinary deficits and high yields. Are you seeing any evidence of that? Is the fiscal landscape impacting your corporate strategy at this point?
So I think so far, ironically, what's been happening on the fiscal side is I think been helping credit. And I think that's an absolute and a relative case. And in absolute terms, the fiscal support at both the federal and state level, I think, is reducing the odds of a recession, has supported the economy, and that's kind of obviously helpful for credit. But I think also on a relative basis, I think something that's been weighing on Treasury markets has been, the income, the carry is low because the curve's inverted. You get paid more to hold T-bills than extending out the curve. And then supply has been very heavy, or expectations of supply are high. And then if you look at the corporate credit market, it's kind of the other way around. The carry on corporate credit is positive. The credit curve is positively sloped. And issuance has been really undershooting expectations as companies, which I think have more flexibility than the federal government to issue or not, are looking at these yields and we think are saying this is expensive borrowing. We're going to try not to do it to the extent we can. So you've seen less supply on the corporate market, especially the investment grade market, which we think is a relatively positive technical supporting that market.
Andrew, if you go back to, call it late June, early July, I think you'd be hard pressed to find one fixed income asset class that was down on the year, but now we look at it and it's a completely opposite story here. The one asset class that stands out to me that is still up on the year is U.S. high yield. I'm curious to hear your thoughts on that, what's keeping it up and whether or not it can sustain its current performance.
So that's a great point. I mean, I think U.S. high yield has been pretty remarkable in terms of how well it's held up on a relative and absolute basis. And I think with hindsight, it's been helped by the fact that yields have been rising, and generally investors, look to high yield as actually a better performing historical sector in rising yields. It's somewhat shorter duration. And then you've seen relatively little supply out of that market, especially because it's been so expensive for these more levered issuers. And so that's also helped technicals. But, going forward, and I think this has been a really key part you mentioned earlier on the show, you look at what's happening at breadth in the equity market. You look at the underperformance of small caps relative to large caps. And I think that's still actually a relatively troubling signal for the future performance of high yield. I think if the equity market is saying, look, we're getting incrementally more cautious on smaller, more levered, more cyclical stocks, as long as that's happening, I think it's hard to see the catalyst to drive further compression or more compression on spreads. So we think spreads decompress from here. We think that there's already a lot in the price of high yield's relative performance, even if we avoid a recession in the U.S., which remains our base case.
Just quickly, Andrew, how concerned are you that Japanese buyers in particular, big corporate debt buyers in the U.S. are going to pull back, especially with some of the adjustments we're expecting from the Bank of Japan?
So we think that risk so far is moderate, but we do have to watch it. Again, the return on a hedged basis for a Japanese investor into U.S. corporate credit is not good. So we do need to watch that. We do need to see still if the flows on an unhedged basis continue. Our base case is that they do, but I think that's something subject to what we might see this week.
Andrew Sheets of Morgan Stanley, thank you. I mean, to me, Damian, that's one of the questions underpinning spreads, because one of the biggest buyers, particularly investment grade, has come from Japan. How much are we seeing a shifting landscape? If full faith and credit isn't getting a bid, why is high yield?
Right, Lisa, no, I love it when you start talking about crowding out. That crowding out effect is real, and it's going to be meaningful here. And I think, you talk about the scarcity value, not enough paper in credit. Well, that's all fine and good, but eventually you're going to realize that, my goodness, forget about the crowding out impact. You're going to have to, it's just going to overwhelm a lot of investors, a lot of fixed income investors. I think we're starting to see that here.
Well, and if it's all about supply, aren't the people that actually want the loans, aren't the people that are actually looking to the market going to be the high yield borrowers?
Exactly.
So if it's about supply and it's really about just the issuance trends that are driving corporate credit markets at this point in time, then you've got to think longer term, what's the real viability of this debt? How sustainable is this? Because these are the weak players in the market.
Which is why everyone's talking about a maturity wall. Everybody's talking about what are these companies currently doing to extend that profile. And I keep hearing about all of the deals being done in private markets to extend current deals.
It's all about private credit.
It's all about private credit and all of that. But then all of that is kind of predicated on the idea that benchmark yields are going to go back down in the next 3 to 4 years. So that's something that we need. I'm curious about how that's going to
Still a lot of dry powder
evolve.
in private credit.
That's what everyone keeps saying. Right now in the markets, you are seeing people put dry powder to work, maybe in a buy the dip moment. 0.7% gain on the S&P. You could see even more when it comes to what we're seeing in the NASDAQ. Really, I am curious, though, when you talk about these dispersion, you talk about small caps and what's happened there versus credit, is it correlated still, right? I mean, to me, who's right? Everyone talks about junk bond traders being the sort of smart guys in the room in terms of analyzing it. Would you beg to differ?
Well, sometimes it's not apples to apples, right? If you look at the small cap index and you look at the constituents in small cap equity, it's a lot of healthcare and a lot of financials. Yep. That's not necessarily the same story that you have in high yield, which historically the weakest players in high yield have always been the energies and the telecoms of the world, where you expect the default rates to go higher. And we're in a very bizarre universe where energy stocks have not borrowed too much money, or energy companies have not borrowed too much money. So I think that's part of what explains what's going on in high yield versus what's happening in equities. It really is about healthcare. And nobody talks about this because everybody thinks healthcare is this defensive sector, but our view is healthcare developed a bubble in the pandemic, and we're seeing that bubble deflate very, very rapidly. And that is part of the reason why small caps have underperformed so materially, is it's just this, oh, wait, the pandemic seems to have gone away. We seem to have resolved our crisis. We overbuilt this idea that healthcare would be this huge portion of growth. And it isn't.
But Ozempic, isn't Ozempic going to save it all?
The weight loss drugs are not replacing the pandemic story.
Okay,
sadly.
Well, I don't know, maybe, depending on who you talk to. Everyone's going to take Ozempic. It's going to lighten the load in airplanes. It's going to make people stop eating fast food. It's going to do your laundry. Coming up, we've got Elliot Ackerman, a Marine Corps veteran and former White House fellow, as we try to parse through the machinations over in the Middle East.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
From New York City,
From London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I think the U.S. response has been measured. There's a deep sense in Washington that we don't want to be pulled into this conflict. I would be careful about looking at sanctions as having too much of an impact on the various adversaries at this time. You really have to ask yourself, when you look at a specific sanction, does this touch the decision maker at the top of the pyramid of an adversary? And the sanctions that have been put in place against Hamas recently are important, but don't really meet that measure.
Norman Rule speaking, former U.S. senior intelligence official and senior advisor at the CSIS Transnational Threats Project, talking earlier about how the U.S. gets more involved from a financial perspective. Tom and John both off today. They will be back later this week. I am so glad to say Damian Sassower and Gina Martin-Adams alongside me today as we parse through how to understand what is noise, what is real, what has legs, what's an escalation, and really try to get our handle around the meaning behind the conflict that has been so divisive, so emotional, and so horrific based on the personal tragedies. S&P futures up 0.7%. You can see crude down 1.25%. partly because there hasn't necessarily been the hardline escalation that some people were expecting with the ground invasion. Joining us to understand all of this is Elliot Ackerman, someone with on-the-ground, boots-on-the-ground experience in Fallujah, U.S. Marine Corps veteran, former White House fellow, and co-author of the 2034, a novel of the next World War. I hope we are not entering into another World War. Elliot Ackerman, I want to get your sense of what you make around the fact that we have not seen a greater escalation and what the chances are for that at this point based on the measures taken.
Well, I think what we've seen is very deliberate military movements on the part of the Israelis. I mean, pretty soon we're going to be a month since the October 7th attacks, and we haven't seen them rush headlong into Gaza. And then we've also seen the United States take measures by moving 2 carrier battle groups and other forces into the Mediterranean to dissuade the Iranians or Hezbollah from coming in from Lebanon into the north of Israel. So this counter offensive is playing out in a really deliberative manner, and I think that so far we're seeing that is stopping this war from turning into a regional contagion.
Yet it does seem that most of the rhetoric or statements coming out of the region, Elliot, are about the war really continuing, or at least getting started, the ground troops really getting busy now, which would suggest that there's not a lot of end game in sight. It seems that we're getting going, and the assumption is that this is going to take some time to play out. Is there any resolution in your mind in the near term, or is this another war that we're going to contend with for an extended period of time in a very similar fashion to what's going on in the Ukraine?
You know, I think there's a tendency when we look at wars is we focus a lot on the movements of ground troops and the real specifics, and that's important, of course, but it's also important to hold in your mind at the same time, you know, the idea that war is politics. It's politics by other means. So what are the politics of this situation? And this attack on October 7th was, you know, by all accounts, launched as a counter to the Saudis and the Israelis signing a peace deal that would disempower Hamas and put Iran in a very difficult position in the region. And so by basically forcing an atrocity on the Israelis, Hamas forces an Israeli response that causes that peace deal to collapse. So that's what we're seeing right now. So this kind of poses an obvious question, which is, who is the party that actually has the leverage at this point? You know, Israel doesn't have a ton of leverage because they have to respond. Hamas is waiting for that response. I would say the people who have the most leverage right now are the Saudis. You know, if the Saudis were to turn around and start renegotiating this peace deal at any point, it takes away all of the leverage that Hamas and Iran have created. And I think we have to, as much as there's a lot of discussion about the fatigue that the world is going to have when we start seeing the Israeli military operating in Gaza and the civilian death toll. I think there's also some fatigue that the Arab world probably has with the Palestinian question, particularly in the context in which Hamas is inflaming tensions. And, you know, could we see possibly a peace resumed out of the Arab world on this question?
Elliot, you're a former Marine, 5 tours of duty in Iraq and Afghanistan. The one question I have for you is, these tunnels underneath Gaza, how do you infiltrate these tunnels? I mean, what does that look like? I mean, I'm just curious, like, is there any precedent for that?
Well, I mean, there is historical precedence for that, but I can't emphasize enough just how challenging that operating environment is. You know, a major urban center is the worst place that you want to be fighting. You know, the closest analogy I can come up with based off of my experiences in Fallujah is it's like being in a knife fight in the phone booth. Everything happens at very close quarters and very, very quickly. And many of the high-tech weapon systems that armies like ours and like the Israeli army are invested in, they become much less effective because of the close quarters natures of the fighting. And these tunnels make it extremely complicated for the Israelis because they have to go in, they have to map out these tunnels, figure out where they are, and you also have hostages that are being held in these tunnels. So at the tactical level, you couldn't have posed a more challenging problem to the Israeli military. I don't believe it's insurmountable, but it's going to make it very, very slow going, and it forces them to act extremely deliberatively, which I think we've seen so far.
Well, you said that it's not insurmountable, and I want to really develop that point a little bit, because there were a lot of people saying, what does it mean to beat Hamas? Can Israel win this war? What does winning look like? From your vantage point, what does winning look like?
Again, I think winning, at least as the Israelis have defined it, is the destruction of Hamas and then some normalization or stasis in security in the region. So Israelis can continue to live in all parts of Israel, in southern Israel in particular. Now, when it comes to destroying Hamas, that is, it's going to take some work, but that is tactically viable. I think the question that is now, what do you do in Gaza? And do you face a protracted insurgency in Gaza? And I think when it comes to this idea of normalizing relations in the region, that's when we start to get into questions of diplomacy. Can Israel and can Arab partners negotiate with whatever the inheritors are of Hamas, whatever that Palestinian Authority is, to create stability in the region? We haven't gotten there yet. But again, what I'm seeing is we shouldn't underestimate the fatigue that also exists in the Arab world with this conflict, because it seems that this war was predicated on Hamas blowing up the best chance for peace that had ever existed.
You talked about how Saudi Arabia arguably has the most leverage in all of this. We do have a Saudi official coming to Washington, I believe, this week. Axios was reporting. I'm wondering what the goal is among some of the Arab nations that have the leverage, have the power. I'm thinking, yes, Saudi Arabia, but also maybe to a lesser extent, Qatar and also the United Arab Emirates. What do they want?
I think they want to live in a region that isn't plagued by this systemic war in Israel between the Israelis and the Palestinians, to allow peace to finally break out in the Middle East and to live in a region in the world that isn't, when it's spoken, the Middle East, we don't immediately think conflict, war, in a place where, security isn't assured, that maybe the Middle East can start to look a little bit more like Western Europe. I think that is probably what they want. I think that's what everybody wants. And again, I think we shouldn't underestimate the fatigue that exists on all sides of this conflict.
Just 20 seconds. Do you think that their goal is for Israel to survive or not to survive?
I think their goal is for Israel to survive.
Elliot,
I do. I think it's difficult for them to say that, but yes, I do.
Elliot Ackerman, thank you so much for taking the time and giving us a sense. And Damien, you were talking about the experience, the boots on the ground of seeing what it's like and just how challenging this ground operation is going to be for everybody involved.
Yeah, and the American war machine is back up and running. I mean, defense spending here in the U.S. is up 4.9% in the year through September, right? So, I mean, it's not as if, people aren't throwing money at the issue and trying to figure a way through this. But I mean, I can't even imagine, what Elliot's talking about, the close quarter, fighting that's going to take place, and the deaths and the casualties is just going to be unlike anything I think we've ever experienced.
Yeah, this visual of a knife fight in a phone booth really will stick with me for a long time. And I do think that he makes an excellent point about just the nature of the operations in the underground tunnels, as you brought up. How are we going to respond to this? How ultimately does it resolve itself when our sort of wartime operations are mostly air-centric now, or at least above ground-centric? This is a new battleground effectively underneath.
Which raises the question about the budget that President Biden just put out there, right? That's where you're going to go.
It's all interlinked. I mean, what I was going to say is the decision tree. I mean, you think about these tunnels, right? It takes electricity to ventilate them, right? And Israel's cut off all the electricity to Gaza, right? For the obvious reasons. And it's just, it's just amazing. At what point does the rubber meet the road? At what point do you determine that you need to give aid, you need to give electricity to those who need it most, or are you helping Hamas?
And at the same time, the civilians caught in the middle who are experiencing a humanitarian disaster, and we see the pictures, and it's traumatic. Anybody who has, humanity wants the war to stop. The question is, how do you get there? And that's what people are arguing over. Coming up next, Barbara Reinhardt of Voya Investment Management from New York. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
I would think that we're going to see the peak in 10-year yields over the course of the next 2 or 3 weeks.
The soft landing is the most likely outcome.
My forecast is for slower growth. I think these higher interest rates have actually increased the chance of a recession.
We are probably within 50 basis points of a peak in rates.
There are winners and losers emerging in this new world we've moved into.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Heading into the last 2 months of the year, bonds and stocks sending slightly different messages. Welcome back. Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John off today. I am so lucky that I am greeted with Damian Sassower and Gina Martin-Adams, who are still with us, even despite the fact that I had to up the bribe. I really appreciate you guys being there. It seems like a tumultuous week. And I started by saying, you know, our bonds and stocks sending a slightly different message because we've been talking about this. It seems like bonds are saying strength and resilience. Stocks actually not so much.
Yeah, or stocks are just reacting to bond market yields. I mean, it's very difficult to say because it doesn't look like there's been a massive shift in the earnings outlook or the economic outlook to stimulate the decline that we've seen, yet sentiment was a little bit irrational in the middle of the year. And we've seen a major pullback as yields have accelerated quickly. So it could just be that this new correlation that exists now between equities and bonds is really playing out and playing out in a negative fashion for equities.
Yeah, no, and I mean, sentiment's just being one part of the equation. We get a lot of data this week. You get a U.S. data dump, we get ECI, we have payrolls, we have the Fed, we have the QRA. You know, it's just going to be interesting for me to see how sentiment can hold up as well as it has in lieu of all this.
Let's parse through some of the acronyms. So we're talking about employment data with its employment cost index. We're talking about the potential for how much debt the U.S. is going to have to add to the current debt pile without the Fed necessarily buying. But we're also talking about just the nuts and bolts, the fundamentals of the economy and how central banks view that. What's most important? And we keep talking about this, and everyone says it's all of it, right? And then at the end of the week, everyone says it was the ECI that did everything. It was the University of Michigan Sentiment Survey. What is that one key thing that could really change the dial?
Look, I don't know that there is one, but one thing you didn't talk about is Apple earnings. And I'm going to keep coming back to the fact that ultimately stocks are the value of future earnings stream, right? So ultimately, you're getting an ownership in a company. What the companies do with their earnings will matter to equities. So Apple, being one of the biggest stocks in the world, is very important and consequential. We need to continue to see relative stability out of the earnings stream to really see stocks hold up.
But it points out that Apple and stocks are not the economy, because the stock market is basically Apple, Microsoft, Google, Amazon, et cetera. They're doing fantastically. Everyone else is struggling. How are you expecting to see that really play out in the other areas? And that, I think, is one of the key questions.
Yeah, no, I agree. I mean, it's interesting, though. It's not just about tech. It's about UPS, right? UPS is a good barometer of economic sentiment. And, UPS didn't even come in so healthy. So, I guess there's a lot to take away from earnings. But you're right. I mean, tech, I think that's the leader here. And to see what's going to happen this Thursday with Apple is definitely going to be a market driver.
And let me just reiterate something you said, Lisa, because this is something I think investors completely forget half the time, is the economy and the market are not the same thing. Earnings are not necessarily directly one-to-one related to what's happening in the economic data. You've got to really parse through the economic data for what's meaningful. Going back to another conversation we recently had, if you get caught up in the 250 different economic indicators that you're expected to follow on a monthly basis, you're going to miss a lot of opportunities in the equity market. What's really meaningful is really important conversation point.
Well, what's meaningful right now is markets are up, despite all of the uncertainties that we're talking about. And I guess that really goes to exactly the point, Gina, that you're making. Right now, it's the S&P futures up 0.7%, 41.65. Euro just gaining slightly, a bit of a bounce back after some of the losses versus the dollar last week, 105.85. 10-year yield is climbing. And this, to me, is going to be really interesting, especially throughout the day. We do get some initial guidance from the Treasury Department that refinancing is going to be key. Get some today. Wednesday is the full thing. 4.89%, crude off just a touch, with this feeling that at least we're not getting the same kind of escalation that people had expected with what's going over in the Middle East. But I keep coming back to, when are bonds going to act as havens again? When we start talking about all the headwinds, and stock markets are not the economy, but the economy is seeing headwinds. And that, I think, is what people are focused on, especially with the Middle East and the conflict there. Joining us now, Barbara Reinhardt, head of asset allocation at Voya Investment Management. Are Treasuries still haven?
We think that they are. We think that bonds are showing probably their best value in the better part of the past 15 years. Right now, on inflation index securities, you can get a 2.5% real yield after inflation if you hold the bonds to maturity. And we think that because real yields are now positive, they're back up towards levels where we would see they're acting like a ballast against your equity market portfolios. We think that that correlation of returns between stocks and bonds starts to return back to some level of normalcy. This is the first time, really, since the global financial crisis that we can say bonds are material value for all types of investors.
So how do you really make that determination if it's not just about the fundamentals, but it's also about how much debt the U.S. sells? It's also about just where the buyers are going to come from. If the Bank Japan, it really abandons yield curve control. How do you know? How do you parse out the dynamics of that, the technicals versus the fundamentals?
Look, it's very difficult to call the top in any type of market. Ask the most astute of investors, and it's an extremely difficult proposition. But we take a look at long-term fundamentals, and we also have a lot of good models that tell us about the trend of underlying economic growth and where that should be relative to bonds. And we do think that inflation is likely to continue to fall over the course of the next few quarters. We think that the Fed is getting very close to being finished at this point. Even if they were to raise interest rates one more time, you are likely in the part of the cycle where the Fed is finished raising rates. And we have studied this many times, almost all times, when the Fed has finished raising interest rates, within 12 months, you have had a significant rally in bonds. Lastly, you're also at a very good point on the duration curve. Right now, if you were to own a 30-year Treasury, and if yields were to go up by 50 basis points, you would only lose about 3%. If yields were to decline by 50 basis points, you have a gain of 13%. So there's this real magic to duration at this point, and it is very much in investors' favor.
Okay, so in an environment where bonds potentially rally, you're also in an environment where yields are positively correlated with stock prices. Can you make a case that bonds rally as stocks rally as well in 2024?
Oh, easily. I mean, look, you saw that type of sensitivity just over the course of September as well. Bond yields were starting to come down, and stocks were just rallying very hard at that point. I would say we're probably at the point of the cycle where stocks are in a bit more of a wait and see mode, right? Right now, you have sentiment that isn't necessarily in your favor to own stocks. The other issue, as well as breadth and technicals in the U.S. S&P 500 are not looking all that great at this point. You've got a number of stocks that are below their 200-day moving average, and you kind of need to see some of those things go back in a little bit of better favor to get that relationship where yields come down and stocks can indeed go up.
So, Barbara, bonds are back, and they once again can provide a ballast for diversified investors on the equity and fixed income side. My question is, the fixed income market is a $57 trillion market. So if bonds are back, where do I want to park my assets?
Well, so the way that we're thinking about it is we're buying longer duration treasuries at this point. That's where we think that the most value is. But there's an easy case to be made also that there are some very good yields to be had in, the high yield market right now is yielding over 9%. That's a significant, potential for total return and also, just interest rates and carry for investors. But what we're doing in our portfolios, and again, remember, we're managing for retirement, so we have a 40-year horizon. Right. We're adding longer duration treasuries to our portfolios because we think that the yields to be had after inflation are very attractive, and it can also act as a diversifier against equities.
I'm curious what your thoughts are on mortgage here. And the reason I say that is I'm playing on what you said. 12 months after the Fed stops, typically you see, some pretty significant cuts. That market would
Oh, not cuts, declines in yields.
Declines in yields. Okay, very good. But I guess that kind of a scenario, for lack of a better word, you would think would benefit the mortgage market, right? Because, again, it's bankability to buy that paper. What are your thoughts on mortgages at current levels, given the underlying fundamentals for U.S. housing?
Yeah, I mean, look, the housing market's going to be much slower to react because even if bond yields start to decline a bit, it's going to take time for banks to lower mortgage rates. So we think that the housing market is really beholden to a couple of things right now. A lot of people that own mortgages at this point have them at very low rates. Something like 3.5% is the average outstanding mortgage for a U.S. homeowner. It's going to take yields to drop dramatically to kind of unleash some of these transactions in the housing market. So I would say that mortgages are probably a good buy, but you have to have a bit more of a longer-term horizon.
I want to go back, if we could, Barbara, to the correlation comment that we were talking about, correlation between stocks and bonds, because I think this could be very consequential for asset allocation at large. How are you advising your clients to create the mix of asset allocation in an environment where stocks, prices, and bond yields are suddenly positively correlated, coming off a 20-year environment where they were negatively correlated? Has it changed your outlook for mix between stocks and bonds?
Well, look, don't forget, we're investing for retirement, so we have a very long horizon. When we're thinking about our target date funds, those mixes are set by our strategic asset allocation. But the one thing that we are doing is our 10-year outlook. So our 10-year ahead forecast for both stocks and bonds, it is surprising how well we expect bonds to do over the next decade. So the returns for stocks are relatively low because they've had a lot of that expectation has already been built into markets over the past decade. But the return for bonds over the next 10 years is north of 4.5%, which tells us that it's going to be very competitive. It's a big competition for equities at this point, where it hasn't been for the better part, since 2009. That means likely that you're going to see more flows into equities. You've had big flows this year into long-dated Treasury ETFs, which we think is just a sign that investors are perking up to these better yields that are available.
Barbara Reinhard, thank you so much for being with us.
Thank you.
Voya Investment Management. There's a magic to duration. I can just imagine there's going to be some kind of meme to this. Just throwing that out there. But this is what people have been trying to hook into for so long. And yet it hasn't worked. And this has sort of been the conundrum for a lot of people. When do you sort of get in there?
Yeah, and a lot of people were saying 5, but I've started to hear 6 now. It's interesting how at 4 it was, 4's great, and then, it'll be 5, and then we hit 5, and now I hear 6.
Yeah, well, I think Barbara makes a great point. That asymmetry in terms of total return projections, right? I mean, yields can still go up, but you stand to lose a heck of a lot less than if yields come down. And I think that's, if you're a long-term investor, you really just can't ignore that.
If you're just joining the program, you do see a bit of a lift again to those yields. So even though people are coming in, not enough to suppress things. 4.89% on the 10-year. S&P futures up 0.6%, 4,162. To that point, this is sort of a question mark, right? Is it enough time that even if there is going to be something that happens, whether it's a demand side thing or whether it's inflation reaccelerating, people still have the confidence to go in? I think this week is actually the tipping point. Maybe I'm just making drama because that's what we do, but at a certain point, don't you say when you get the refinancing agreement and then you see the market's reaction, isn't that going to be telling?
Well, I mean, the U.S. government can still shut down in a few months' time, so there you have it. No, I'm just kidding. I hate to go there, but I mean, look, I agree. I agree.
Carry on.
Speaking of creating interest.
Go on.
Look, I think there's no denying the fact that fixed income has its merits in this environment. And look, in an environment, quite frankly, where you're lacking in safe haven options, fixed income can really play that role. It can really add balance to your portfolio. It's an absolute it's a necessity to have a proper fixed income allocation in today's day and age.
Who are you? You're just like the way he's sort of saying right now. No kidding, right? What you were going to say?
No, I was just saying exactly, right? Because what's happening in the equity market over the course of this year, it's been all about those safe havens that have performed really well. And it's only the safe havens that performed well in this environment of just abject risk intolerance because bond yields have been moving higher. Well, what really sparked that whole story was inflation and the central bank's response to inflation. But we're starting to get that narrative shift from the central banks. We started with the ECB. Will we see the follow-up with the Bank of England, with the Fed, with your slew of emerging markets?
And those safe havens are Apple, Microsoft, no, I'm just kidding.
Yeah, exactly. It's not treasuries, which has been the whole point. But coming up, we're going to be speaking at 8:30 a.m. with Tiffany Wilding of PIMCO. And ultimately, yes, you're talking about the Fed, the Bank of England, the Bank of Japan. But how much does it just come down to how much inflation keeps coming down versus the potential for reacceleration?
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg, context changes everything. Earning Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
I'll let the Israeli Defense Forces speak to their plan, and war, of course, is highly unpredictable, so it's difficult to predict how it will play out. We will continue to talk to our Israeli counterparts. We'll continue to ask hard questions about how they are thinking this through, how they are proceeding, but ultimately these are their decisions. If American troops are attacked by Iran and its proxies, we will respond. We did respond. If attacks continue, we will respond.
Jake Sullivan, U.S. National Security Advisor, speaking on ABC. All of the different politicians took to the airwaves, and probably the one that I found most interesting was the new House Speaker, who came out on Fox and discussed the idea of splitting aid to Israel and Ukraine apart, the idea of cutting some of the budget to offset those kinds of expenses, as well as what this means for President Biden's popularity at a time where his own party is getting splintered. Joining us now to really parse through this is Terry Haynes, founder of Pangea Policy. I want to start with Mike Johnson. What we heard out of him over the weekend, how surprised were you to hear some of his points that sound very much like a playbook that comes from another time?
Well, I wasn't a bit surprised, actually. I've been writing for markets for weeks that the strategy that would get pursued is, breaking all these pieces apart instead of Biden's idea that they should all be rolled up together. I think what markets ought to notice too, though, is what Johnson doesn't say. What Johnson doesn't say is he's foursquare against Ukraine aid. Ukraine aid shouldn't happen, that it won't happen, none of those things. What we've got here, what I was always fearful about, and I think is coming true, is that this is going to become a fight about how all these things get done, these things being Israel aid, Ukraine aid, border security enhancements, and that's going to take up most of the rest of the year, but I do think they all get done in the end.
So they get done. We continue to fund or support these two wars. Where do we cut spending in order to accommodate them?
Well, we don't. Bottom line, no, we don't. The good news and the bad news is really is that on-book spending has really been consistent for the last decade plus. Off-book spending and our commitments, whether it be to housing or to a variety of other things that are kind of under the line, continue to balloon, and that's a big problem. Washington has not yet gotten the memo from the markets that the markets for the first time in 40 years are very concerned about rising debt, rising deficit, and rising U.S. fiscal spending. There isn't a politician in Washington other than Biden himself that's ever heard markets be concerned about that. And, Biden's not in a position to care or do anything about it because he's beholden to his left wing who think that endless spending is the right idea.
Okay, so we keep spending. What about with China? There's a lot happening with China this week, which is interesting considering so much happening geopolitically around the world, and yet China-Taiwan is lingering in the background. Tell us your views on what's happening with China. Is there meaning behind the meetings this week that we should be reading into?
Well, Gina, as you know very well, every time the markets hear anything good from a U.S.-China perspective, and the current one is the prospect that Biden and President Xi Jinping might meet on the sidelines of the APEC meeting next month, the markets think this is a good thing. But in reality, China's been very blunt about is really through the national security law, through kicking a lot of Western accountants out, now through providing, through a conference this week, more evidence of state control in a variety of areas in financial services, is a world that, as you all talked about in the last hour or so, where China looks increasingly uninvestable. And so I think the kind of the cat's out of the bag on China, and even markets are starting to figure out that that there's not going to be any kind of long-term rapprochement between the U.S. and China. The best we're going to get is a situation where the competitors and the clashers understand each other well enough not to take the next step into a rising yet again geopolitical risk.
Terry, former Vice President Pence pulled out of the 2024 election this past weekend. You know, Trump leads the polling in some of these early states. I mean, it's still early days, obviously, but I mean, I'm curious, do you believe we're past peak Trump? Is there anyone else in the GOP who can even make a run at him?
Well, you know, I'll stick to my earlier views that I think we're a little past peak Trump. What you've got in the early primary states, Damian, is a situation where, you know, the polls right now are basically 50% are in favor of Trump, which means 50% are against him. You probe into the Trump support a little bit more, and you've got another quarter to a half who can be convinced otherwise. And as you point out, it is very early days. We've got, you know, basically 2.5 months before the first, almost a quarter of a year before the first primary season. So, you know, my advice to markets is really twofold. One, stay cool on this till after the first of the year when you have some idea of what's going on, number one. Number two, I think what you do see is a continued winnowing down of the competitors. We're already basically down to 3. We're down to Haley DeSantis and Tim Scott as the leading challengers. Pence understood he wasn't part of that, so he's very honorably bowing out early. But what you're going to get, I think, is a consolidation that happens earlier and provides a much more unexpected, from markets' perspective, challenge to Trump than is now thought.
Terry, Mike Johnson is Speaker of the House, but is he the leading voice for House Republicans? And you know where I'm going with this, right? I mean, you've got Scalise, Emmer, Jordan. I mean, what happens to these gentlemen after their unsuccessful runs for Speaker of the House?
You know, people tend to view new people in positions based on the people that were already there. So markets are very used to that, this strong speaker model, this kind of super majority leader position, whether it be Nancy Pelosi or McCarthy or you know, John Boehner or somebody else. In reality, what you've got with Johnson is a situation where the party regulars, Scalise, Emmer, Jordan, are more empowered now than they were before, and they're really going to be leading the party much more than Johnson. That said, you know, one of the things Johnson also said on the Sunday shows, which bears underscoring, is that, you know, they're looking much more seriously at extending government funding beyond November 17th than they would have been, say, a month ago. So, you know, so I have accordingly put my own odds back down to about 40%, but I think the political situation's volatile, and I'll be ready to put him back up again, you know, if and when the Republicans fall apart.
Just quickly here, we're talking about the Republican side and the nominees for the election. Why was Gavin Newsom in China?
Ostensibly to talk about economic ties and all the rest. Really, what he's doing is trying to do what he can to burnish his foreign policy chops. You know, there's a lot of sharks in the water now, and that wouldn't surprise me if Biden's feeling like a remora a little bit, and should they falter. And you saw evidence of that even with Vice President Harris's 60 Minutes interview last night. But, you know, Newsom wants to put him out there as the alternative, himself out there as the alternative. Republicans would love that because Newsom wouldn't get a vote outside the solidly blue states.
Terry Haynes of Pangea Policy, thank you so much. Those video images were quite something when we saw, Damian, the idea of Gavin Newsom playing basketball with some kids in China. That didn't go over too well.
Well, I mean, look, he's no R.J. Barrett, he's no Jalen Brunson on the New York Knicks. But I mean, look, you know what I really wanted to ask Terry, I never got an opportunity to do that, is, you know, with all this geopolitical risk that's going out there, all this mishigas, what is the pain trade today, the real pain trade for investors? You know, is it, you know, something blows up in the Middle East? Is it, you know, China-U.S. ties souring that much further? I'm just curious, you know, what is the pain trade for investors today?
I think the pain trade as something positive. Notice that your pain trade was all of these potential conflagrations, more negativity. I think the pain trade is all of a sudden we get some resolution. That is certainly not in any consensus view.
I will take that pain trade any day of the week, so that's all.
You know, I'm an internal optimist, Lisa, in case you didn't notice. There's a reason I work in the equity market.
That's right, and there's a reason why I focused on bonds, and I think
there's a reason I'm focused on emerging markets.
Can relate. He goes even further down. Coming up, Tiffany Wilding.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
60 minutes until the opening bell, and we can see a bit of a buy the dip continue today, led by the NASDAQ, although off some of the earlier highs. The S&P futures up 0.6%, basically just hovering around these levels all morning. We're looking at a bit of a sell-off, though, that is extending in the 10-year yield, which is interesting to me, 4.9%. It had been 4.86 earlier this morning, so the longer we wait, the more yields are going up. And crude off just a touch, given the fact that maybe there wasn't as much of an escalation and that Israel didn't have as aggressive of a land operation in Gaza. Tom and John both off today. Very pleased to say Damian Sassower, Gina Martin-Adams alongside me as we parse through what's going on this week. A real slow week, not much going on. Michael McKee, Bloomberg Economics editor here.
I don't know why I got up this morning.
Yeah. Why do we ever get up? No, this is a huge week. It's really pivotal to understand the inflection point for the economy, whether it has to do with jobs or whether it has to do with central bankers. What is the biggest surprise that you think is likely based on what you're hearing from whisper numbers and your economist sources?
I think most of the economic data will probably come in about as people anticipate. I think the big question this week is bond yields. Where do they go? Because there's so many things that can influence them. One thing people are forgetting a lot about is that the Bank of Japan is meeting tomorrow. And there is, according to folks like Kit Jukes at SocGen, about a 50% chance that they widened the band for yield curve control. And as the 10-year note yield continues to rise in Japan, that attracts money maybe away from the U.S. at a time when the U.S. Treasury is going to come out and talk about how much it needs to borrow. And so we could see yields rising even further, and then that has the follow-on effect in the economy that everybody is talking about from the Fed. They can stand pat because interest rates are doing the job for them.
We've clearly got the Fed meeting this week as well. So again, no shortage, along with a bunch of central bank meetings. How much is this yield rise that you're referring to going to be part of the discussion? How much is the bond market doing the work of the central banks already, I guess is the question.
Yeah, I think the Fed has pretty much told us that that's the way they are thinking about it. Now, they may have decided that they have done enough anyway because there is the lags effects that we're starting to see impact more of the economy. But with rates, market rates rising, that's doing some of the Fed's work for it. So their question is going to be, how high do the market rates go? But we know the Fed is probably not going to do anything. Is less than a 2% chance that they change rates at all. So then it's going to be what Jay Powell says. Does he suggest that they're done and they're going to just let the markets do their thing? Or does he suggest that they're going to keep their options open and leave us all more confused for a few more months?
So, Mike, I mean, I know you're focused obviously on the U.S. economy and developed market central bank activity exclusively, but there's a lot of emerging market central banks as well, right? I mean, we have Brazil who's expected to cut. We have Colombia who may cut as well, Czech, Malaysia. Do you care about any of that? I mean, and from an extension of that, let's talk about the Norges Bank, right? I mean, Norway has actually proven that as a developed market central bank, they are targeting currencies and currency levels as opposed to maybe inflation and growth. Talk to me about that.
Well, there are a few, Norges and maybe Denmark targeting currency levels, but the rest of the banks don't do that because it's too hard to do. I mean, you can't guarantee that what you want is what you're going to get from your moves. The rest of the world, I would put it this way: it doesn't matter to the Fed other than whatever feedback effects there are, but the Fed matters to the rest of the world. All these banks are reacting to what the Fed is doing because U.S. interest rates are setting the pace for the rest of the world. One interesting thing will be next Tuesday, a week from tomorrow, when the Reserve Bank of Australia meets, because they are expected to possibly raise rates. And they may be the only one of these non-big banks that are doing that. So that's something to keep an eye on.
I'm sitting here smiling because Damian, you know, we're talking about all these other things, and he just is going to double down. What about those other central banks?
He will shoehorn those emerging market central banks into any conversation. It's amazing.
Yeah. Well, hold on. We talk about Norges Bank. We'll talk about Norway. Look,
all right, go ahead.
Norway has proven that. Look, and I mean, admittedly, it was their it's in their calculus. You know, they are targeting currencies, and Mike, with all due respect, you know, a lot of central banks, whether they admit it or not, are targeting currency valuations and levels relative to the dollar. They can write it off as if they're targeting inflation. They can write it off as if they're targeting growth. But at the end of the day, they have no financial system if their currency falls out of it.
And there's a real question about how you target that at a time where it's unclear whether it's rate differentials or whether it's economic growth that's really driving some of those
currency moves. This is not a fun time to be a central bank.
No. So it's nice to be in the peanut gallery. Michael McKee, thank you so much for being with us, joining us now. Someone else who can join us in the peanut gallery to try to understand exactly how central banks are going to deal with this. Tiffany Wilding, economist and managing director at PIMCO. So glad to have you on the show. We were talking earlier, and Gina made this great point about how she thinks the pain trade is actually to the upside in equity markets. Things go better than expected. Earnings come in stronger than expected. Is it the same with economic projections that the economy, if it reaccelerates, that's almost the pain trade right now, given where people are situated?
Yeah, I mean, I think some of that has been, quote, priced into the economics community's forecasts. I mean, you saw many economists that were penciling in a recession earlier in the year. You know, and obviously, if you look at the consensus numbers, those have come up. I mean, certainly that can continue. And it's definitely been a risk that we've been highlighting as well. You know, and in particular, the consumer, you know, it's certainly possible the consumer remains strong. The consumer did basically reaccelerate their, you know, their consumption and their purchases into the back half of this year. You know, and it's a question of how interest rate sensitive the consumer is, and it's proving to be not that interest rate sensitive right now.
Which raises a question also, Tiffany, what's the connection between growth and inflation? Is there a sense that if growth accelerates, you can still see the disinflation continue that we've seen so far this year?
Yeah, I mean, so this has been a point that we've been trying to really hammer home, which is that it really, you know, there'll be some continued disinflation as a result of, you know, the fact that you're still getting, you know, the product market side of the economy. So the side of the economy that was impacted by some of these supply chain snags, you're still getting some normalization there. But labor markets are incredibly tight. And you are still seeing a pretty decent amount of nominal income growth as a result of that labor market improvement. And so, you know, we think you probably still need some labor market softening in order to just get inflation, you know, kind of more truly back down to target. Yeah, so if you have an economy that's reaccelerating and a labor market that's strong, you know, you should, this services, ex-shelter kinds of metrics that the Fed is looking at, those probably will start to reaccelerate.
Tiffany, what is the most important economic indicator you're watching this week?
You know, obviously the jobs number, you know, is going to be incredibly important. You know, now there's going to be some noise around that because there was some strike activity. But I think, you know, everybody's trying to figure out what the underlying trend in the labor market is. You know, and as I mentioned, you know, if growth, so the Federal Reserve needs to target growth that's under potential. So that, call it like around 1% is what the Fed is hoping to target in order to cool the labor market off. You know, growth right now looks like it's running at 2.5, 3. So it is well above that, which suggests the labor market is going to remain strong. You know, so we'll, you know, obviously we'll be looking at that. The wage number within the labor market report is obviously going to be very important as well. But overall, you know, we've said if the data flow continues to be as strong as it was in September, you know, certainly the Fed is probably going to want to keep its options open to hike more. We think the SEP could maybe even take out cuts for 2024 just to try to keep those financial conditions tight.
And where do you think that, what is the impact on financial prices then? So you've got the Fed likely to pause. You've got data still coming in reasonably strong. What are financial markets to do with this kind of data?
Well, you know, I think it, you know, obviously kind of good news should be bad news in some sense, right? Because the Federal Reserve is trying to cool off the economy. And ultimately the way they do that is through tighter financial conditions. And whether that's, you know, higher interest rates or, you know, a decline in equities, you know, maybe wider credit spreads, all of those things, you know, that's how you cool off the economy. And so if the economy remains strong, you know, then that's what we need, more pricing like that in order to cool things off.
Tiffany, there's been a lot of focus on the quarterly refinancing announcement. You know, my question for you is a simple one. Is the supply story in U.S. Treasuries already reflected in the price?
Yeah, I mean, I think this is a key question. You know, no, I think it's actually broader than the refunding. I mean, clearly Treasury has had a big refunding need. You know, they've been trying to increase coupons, you know, as a result of the fact that, you know, they have this bigger need and they were really ramping up bills. Now they're moving into coupons. I think the bigger issue here is that good growth, better growth expectations is actually increasing people's expectations for supply. And that's counterintuitive relative to usual experience, because usually you have higher tax revenues and you know, that reduces financing need. But right now, you have central banks that can just continue to, you know, reduce their balance sheet for longer, or you know, the Bank of Japan, which you know, really pulls away from you know, from buying JGBs. That results in more expectations for supply globally, and that's increasing term premiums.
Yeah,
you know, so I think that is going to continue with the refunding.
I mean, Tiffany, you're right in the wheelhouse here, talking about the crowding out effect from Japan to the U.S. I mean, foreign buying of treasuries, where does the demand come from? The Fed's no longer backstopping things. You know, talk to us about demand for U.S. treasuries on a forward basis. You know, who is that marginal buyer? Who's that marginal risk taker?
Yeah, I mean, that's what everybody's trying to figure out, right? And the problem, I think, well, one of the issues is that, you kind of go back to 2014, 2015, 2016, where you had a good amount of bond yields that were negative, and really the U.S. was the only game in town. Well, now with interest rates just across the world much higher, it's possible to get, positive yielding assets outside of the United States right now. Some diversification of portfolios as a result of that is probably reasonable. So I think it is the question of who's the marginal buyer, but not only who's the marginal buyer, but what price are they willing to pay, and what yield do they need to get in order to come back into the bond market.
Tiffany Wilding of PIMCO, thank you so much for being with us. And Damien, to your point, I think it's a great question, which is what's priced in, where are the buyers going to come from, do we understand the technicals? We really don't know, and we really haven't seen bonds performing in the way that they usually do.
And for me, it comes down to the fact that you look at a 10-year real yield at 2.42%, just how high can that go? I heard, no way we're ever going to see 2% in 10-year real yields, and here we are, 2.4%. I mean, it's just mind-numbing, 100 basis point move since mid-July.
So I'm going to ask you, Gina, how many people who do you talk to, stock investors, saying, should I buy bonds?
A lot. A lot. I mean, honestly, it's at 4%, they were saying, well, we've got to start nibbling in. And then it was, 5%, my God, maybe 6% we can even get bonds at. So it's a big part of the conversation. And this is what I call Tara instead of Tina, just to, speak my own book for a moment. The old moniker, there is no alternative to stocks, is completely gone. It's now there are reasonable alternatives to stocks. And it comes up a lot. The allocation story comes up a lot. It's a big reason why investors are all concentrated in the biggest stocks in the world, is what's happening in bond yields has changed the game.
Yeah. Right now, in bond yields, we do see a bit of a lift to the yield as we get older in the session. If you are just joining the program now, 4.9% on the 10-year yield. S&P futures up 0.6%, 41.62. But this is something that people are looking at, Damien.
Yeah, no, I mean, the earnings yield on equities relative to the nominal yield for treasuries. I mean, that is the big, everyone is looking at, and they're saying, wow, you can get a higher yield on treasuries than you can relative to just dividend yielding stocks and equities. It's just interesting to hear that the people you're speaking to, Gina, are actually focused on that.
It is, and it's also interesting, though, that companies have not recognized that they could easily deploy their capital in the form of a dividend to increase that dividend yield to improve their relative appeal. This is something I find fascinating in the U.S. equity market. We're still sitting at a dividend yield of 2% on U.S. stocks. It's just so not appealing, not attractive, not interesting at all. And to the degree you can get yield, it's usually in more distressed entities or rate-sensitive entities, those that are bigger borrowers. And so investors who are interested in playing a yield story are forced into the bond market. There is not really a yield opportunity in equities unless you go to repurchase yield, shareholder yield, where they have found some degree of yield opportunity. And again, that points you back to big cap tech. So it's a bit frustrating that corporates haven't migrated relatively quickly, because there's a lot of cash that could be deployed sitting on S&P 500 balance sheets. It's just sitting there.
It feels like the whole market's been holding their breath, saying, all right, when can we just say this story is over?
Yeah.
We can write the book on this chapter and go back to a normal that we know. And suddenly, over the past couple of months, that's changed. And suddenly people are saying, wait a second, what if this is it?
Yep.
What if this is the new normal? And that starts to become dividends, and that starts to become extending maturities. And that's where you start to have real discussions of what does this world look like in terms of investing and in terms of corporate finance. Coming up, we talk about how oil plays into this space, especially given the Middle East. Marita Sen joining us of Energy Aspects.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bust through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The industry is still recovering from the impact of the pandemic and the lower levels of capital that have been going in across the industry to offset the depletion that's been happening. And so supplies are fairly tight. With respect to the Middle East, what I'd say, it is still an important region in the world. And while to date, the tragic events are not manifesting themselves in an impact, that's something we're keeping a very close eye on.
That was Darren Woods, Exxon CEO, speaking with our own Alex Steele and Guy Johnson last week after coming out with earnings. A real question mark around some of the consolidation that we've seen in that space, and we will get into that in just a minute. Tom and John are both off today. They will be back, though, later in the week. Damian Sassower and Gina Martin Adams both were the unfortunate people who had to join me this morning, and we are the lucky ones that get to enjoy their insights. I do want to just go through a couple names that stood out to me as we went through the morning. Meta today is popping just a touch after reporting that they are planning on offering people in the EU as well as Switzerland the opportunity to pay for a monthly subscription using Facebook and Instagram without any ads. Since it's faded, it was up about 2%. Now it's down about, it's up about 0.8%. But this all goes to monetizing and this idea that people hate ads. So how do you get around that? So do they maybe profit on that? SoFi is interesting because they said that their online lender increased its revenue forecast for 2023 and more than tripled the number of deposits. What do you make of this? The shares are up more than 10%. Gina, the fact that you are seeing some competitive edge for platforms that actually pay interest in a way that the banks aren't.
Yeah, no, I think it's very interesting, especially because this is a smaller entity and no one has wanted to take any risk in smaller banking enterprises in the S&P 500, God forbid, the small cap index. So it could be a sign that maybe things aren't quite as bad as consensus had anticipated. You still are getting the deposit growth. There still is this lingering concern in the market about what that means ultimately for the balance sheet and how much unrealized losses those deposits ultimately create over time. But it could be a sign that maybe we've gotten to a point where we were just irrationally far too pessimistic about what's going on in finance.
Meanwhile, over at McDonald's, and I'm going to go to you on this, Damian, this to me is really interesting. They came out, they beat sales and profits on both numbers, and it's because sales are increasing as they raise their prices. This has been the story pretty much across the board. We've seen this with Coca-Cola too. Those shares up 2.6%. How long can we keep seeing that kind of pricing power?
Well, I wonder if that's indicative more of the fact that people are stepping down in terms of they're not going to restaurants as much anymore. They're stepping down to McDonald's or Burger King or some sort of lesser restaurant venue in order to eat, right? In order to consume. But to your point, the margin story is not going away. I mean, just listen to Gina Martin Adams. Every other word out of Gina's mouth is margins. No, I'm kidding. But
that's very true. Actually, I own this. I own it, Damian.
The margin queen. No, I mean, look. I mean, again, I think margins are important in this environment. I think it's going to be really interesting, though, to see how some of these other consumer-oriented, consumer-focused companies report on earnings.
And right now, definitely, the input costs are a real question. How they're going to meet those. One of those input costs, very much energy at a time where there's sort of dueling points. And I'll take your point, Gina, about are we seeing a lack of a response to some of the geopolitics because the demand just isn't there. Amrita Sen joining us now, founder and director of research at Energy Aspects. And I want to take her question because it is such a good one. Are we seeing a muted response in crude to the geopolitics of the moment simply because the demand is also falling in tandem?
Yeah, I think it's a great question, and I think the right way to frame it is that. But also, there are no direct risks to supplies, and that's probably what's made it very hard for oil to rally. Yes, the region, again, home to the largest reserves and production of oil. But if there are no direct threats, how do you price this in? This is precisely why we've seen a lot more activity in the options market than in flat price. People can't short this market, but the macro picture has deteriorated quite significantly since, I would say, the last couple of weeks. And we have been kind of seeing some of this coming, not necessarily, sometimes a lot of these kind of factors all come together. The European and US demand numbers numbers definitely are weaker. So I think all of that together just means that, crude's probably going to remain range-bound for now. Not much of geopolitical premium in the price.
Can you talk to us a little bit about some of the other energy products? For instance, natural gas is heading into pretty seasonably favorable time of year. The fundamentals, according to our Bloomberg intelligence analysts for natural gas, are improving fairly materially. Where are you seeing natural gas prices headed going forward?
Depends on the region, of course, but if you think about European natural gas prices, they have gone up quite a bit, and weirdly, the Middle Eastern conflict has actually led to some supply losses through Israel and Egypt, of course, lower supplies of LNG effectively. But the market remains well supplied, and unless and until we get a really cold winter, we aren't expecting a huge increase. Prices are already trading significantly higher than the 10-year average, of course, much, much lower than last year's levels, but that is to be expected given that storage is much higher. But also, remember, industrial demand in Europe has not just been temporarily removed because of high gas prices from last year, but dare I say probably permanently reduced. Combination of very high energy prices, lower economic growth, but also the Inflation Reduction Act in the US that has taken industry away from Europe to the US. Again, even in the US, natural gas prices, yes, slowly ticking up given the just seasonally, like you said as well, but industrial activity isn't really all guns blazing right now just because of the economic backdrop.
Amrit, I want you to put your options hat back on for me. I mean, if you look at implied vols across FX, rates, equities, it's actually been pretty well behaved, I would say, over the better part of the last few months. Talk to me about what you're seeing in Brent crude volatility. I know Pemex had its hedging program that may have skewed things a bit, but what are you seeing in terms of vol risk premia, the term structure of volatility in the crude market?
We have seen that pick up. To your point, it had been well behaved, but just over the last couple of weeks, we've had both bond and oil vol pick up. And, we're coming to year end for a lot of trading companies. It's between October and December. And if you've had a good year, why would you necessarily put on a lot of positions, regardless of your views, bullish or bearish, and risk losing some of that when you have to close your books? And I think that's one of the big challenges we are seeing with volatility, and that's exactly why we are seeing more options pricing, because of course people want to have the exposure of what if something happens, but not necessarily trade in futures. If you look at liquidity in the futures market, that has really shrunk in the last couple of weeks.
And Marita, before we let you go, tomorrow is Halloween. You talked about $100 barrel oil by Halloween. We're looking at $89 Brent. We're looking at $84 WTI. Do you still think we could get there? Or, I mean, why haven't we gotten there, despite some of the expectations people had?
Yeah, look, we were almost there, right? We were 97, 98 Brent. I think what has happened with the Middle Eastern crisis in particular is it's actually taken quite a bit of risk out of the market. The demand picture, again, it's been deteriorating. I don't think that's necessarily been a significant change. But if you take away liquidity from the market, of course, ultimately you need buyers to push these prices up. I still think there's a very solid floor for crude around 90, but we do need to get both liquidity coming back and a bit more, because I think one of the big concerns now we are seeing on the demand side is both Europe and US demand starting to come off more aggressively than we have seen in the first half of the year. Perhaps just because people's savings are running out, or just because, we are seeing some of those seasonal factors come through as well. But that's one of the things we are monitoring.
Amrita Sen of Energy Aspects, thank you so much. Exactly to the point, Gina, that you were making, that maybe this is a demand story more than anything else.
Yeah, you just have to wonder. And we have seen, for sure, we've seen PMIs in Europe decelerating pretty rapidly. Most of the developed world is having PMIs crash at this point in time. Emerging markets are still a little bit mixed, but U.S. was already down there. So U.S., we're maybe even climbing out of our lows, but the rest of the world seems to be capitulating to some weakness.
I agree with Gina on the demand side of the story there, but one thing I just want to, a point I want to make, J.P. Morgan, upstream oil and gas spending is on track to reach $545 billion this year, up from $497 billion in the whole of last year. So as much as demand is a part of the story, there may be a supply component to it as well.
Yeah. Very interesting, especially at a time where there is consolidation. Coming up on the Open next hour, George Concalves of MUFG, Sanal Desai of Franklin Templeton, and Dan Skelly of Morgan Stanley. And don't miss this, Balance of Power today at 5:45 p.m. Eastern. Lael Brainerd, Director of the U.S. National Economic Council. A really important conversation for that. And I just want to thank both of you. I know that it's always a long week, this week especially, and you both took the time, and it's a great, I'm sure you really enjoy kicking off your week this way with incredible energy.
The best way to start a Monday.
Oh yeah, something like that.
6 cups of coffee, great.
Yeah, exactly. No, I mean, I think that it's going to be interesting, and we should reconvene after this week and say what was the most important thing. It's going to be some small indicator.
It won't be anything we discussed today, sadly, but we'll find it.
It's going to be a meeting that someone had that hadn't been scheduled, and they're going to come out, and it's going to change the whole paradigm yet again with a new narrative. Right now in markets, you are seeing a bit of a buy the dip moment. Again, although kind of range bound here, fading a little bit as the session grows older, up 0.5%. That 10-year yield, 4.9%.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we could.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A lift to the market after a down week, correction for the S&P and NASDAQ. Can we recover? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, futures rebounding after falling into correction. Israel slowly widening its ground invasion of Gaza with Fed Chair Powell and the payrolls report on deck. We begin with the big issue, bracing for a big week ahead.
Markets have a lot to digest in terms of central banks, in terms of events, in terms of macro data.
The Treasury refunding announcement.
We're only less than halfway through earnings season.
We have those key central banks, the Bank of Japan, the Bank of England.
The Federal Reserve will have a more hawkish hold from the Fed, beating that drum of higher for longer.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
It's this give and take that the Fed has to manage.
The continued strength of the economy actually handcuffs the Fed.
The economic data in the U.S. has been quite resilient. The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
Still extremely tight.
It all comes back to jobs. The labor market is the key right now.
Joining us now to discuss is Morgan Stanley's Dan Skelly and George Goncalves of MUFG. I'm old enough to remember when it was all the Fed every single time. This time, unclear. Dan, what do you think is going to be the most important aspect of a very busy week?
Sure. I think the Fed, Lisa, for sure. And I think continued readouts on earnings, which, so far we're about halfway through earnings season. The numbers themselves have actually been pretty solid. Comments have been solid, but guidance and revisions haven't really held up. And so while you haven't seen certainly a collapse in earnings, and that's consistent with the economy that's been resilient, you just aren't seeing enough upward movement on revisions to justify valuations. And this is a theme, Lisa, Morgan Stanley's been talking about for 3 to 4 months.
And we're going to get back to that in just a minute. George, I know that you actually disagree, and you think it's really going to come down to the refunding agreement by the Treasury Department, the announcement that they put out. Why is that going to be arguably one of the most definitive moments?
Hi, Lisa. Yeah, look, I think one of the reasons why, and we heard it from Chair Powell a few weeks ago when he was at the New York Economics Club, the Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting. Term premium has risen, and this backup in long-term rates is one of the reasons why the Fed probably will skip hiking this meeting.
Right now, we are talking about the potential for some sort of earnings revisions downward, which is exactly, Dan, what you were talking about. Michael Wilson coming out over the weekend, reiterating his bearish view on equities, as he has been talking, saying chances of a fourth quarter rally have fallen considerably, narrowing breadth, cautious factor leadership, falling earnings revisions, and fading consumer and business confidence tell a different story than the consensus, which sees a rally into year end. Dan, some people are saying there already has been a really dramatic sell-off in specific sectors, albeit not at the headline level. Why do you think there's still more to go, even with some of the carnage that we've seen in small caps, in banks, particularly the smaller ones, and consumer discretionary?
Well, Lisa, I would also add to that, the generals have finally been sold off as well. When you look at mega cap tech over the last week or so, you are starting to see a pretty pronounced impact from that sector as well. So listen, we're not in the camp that we're going to see a dramatic sell-off from here, but we think we could certainly see more mixed results. And this remains, as Mike has talked about, more of an idiosyncratic bottom-up opportunity in stocks than it is for the index level, right? And so when you think about the idiosyncratic opportunities, Morgan Stanley's been talking about the data era leadership, the move to industrial application of technology for years, long before AI became the euphoric headline this year. I was catching up with Katie Huberty recently, who runs our research department, previously our Apple analyst, and this theme of this tech diffusion across different sectors continues to be a high conviction idea. So once again, Lisa, it's more an idiosyncratic opportunity from here.
Which raises a question about the overall index getting challenged and how much that really does stem from yields. George, from your vantage point, how much do bond yields up, priced down, really reflect the risk aversion that we're seeing under the hood in those select areas?
Look, I think long duration plays, which a lot of these longer duration tech companies have been closely aligned with rates, really. But over the course of the middle part of this year, there was a decoupling between some stocks, these high flyer stocks, and the Treasury market. Now I think we're recoupling. Having said that, we've had a hard time breaking above 5%. We've kind of broached it a few times on the 10-year, and until we actually clearly break above 5%, I think it's going to be hard to say that we've seen the top in yields yet.
So, George, is that what you're looking for, a technical level, or is it something specific, whether it's the Bank of Japan and understanding the reaction function, or understanding what yields do in response to the potential for the U.S. to sell more debt?
look, we've been on this view of the higher supply, driving term premium, driving bear steepeners, really since July. And I think the thing is, a lot of it's priced in. We finally got positive term premium. The curve is at least disinverted to a certain extent. And we do get the quarterly refunding on Wednesday before the Fed. I mean, a lot of news probably is priced in. Unless we get a lot more supply, perhaps we'll get some relief here and we'll just start trading in a range. However, if we do get a bigger supply announcement than what the markets are expecting, and markets are really fearful of who's going to take down all this paper into year end when balance sheets are getting very precious.
Which raises a question, Dan, how much lower yields are good for equities that have been a bit beaten up by higher yields, and how much they're bad based on potentially negative economic news. From your vantage point, could you see a scenario where yields go down and that actually gives a boost to equities?
You know, it could, certainly for that kind of Big 10, Big 7 mega cap cohort that, you know, has very much traded in line with yields over many years. So that's number one. Number two, however, I think the story around labor resilience and tightness in labor, tightness in the housing market and housing prices holding up, I think these stories are going to start to fade away as we go into year end. Frankly, when you look at 5% plus real growth in the third quarter, vis-a-vis higher energy prices, finally the lag effect of higher rates impacting consumer financing, the exhausted savings. And when you look at the fact that rents, market rents in the shelter environment are going to have to catch up at some point, and we'll see that slowing as well, the reality is that the market's going to care more about growth going forward, right? So I think this whole idea about inflation staying higher for longer is going to start to fade, and we'll start to see stocks and sectors correlate more towards growth.
Meanwhile, investors gearing up for a busy week ahead, as we were mentioning earlier. Key central bank decisions, a Chair Powell news conference, and the latest payroll report, all in the pipeline. Joining us now to parse through this incredibly dull week with nothing going on is Michael McKee. As always, Mike, it's incredibly important to understand not only the events, but the reaction to them. What do you have your eye on?
Well, the reaction is going to be the issue because these events are widely anticipated, and you only put up a few of them compared to what's actually going to be on the calendar. Don't worry, I'm not going to put up more. I'm going to talk about the ones that are really going to matter and could get the biggest reactions in the markets. Now, the Bank of Japan is going to be interesting because they're not expected to change their interest rates, but they may tweak yield curve control, and we'll talk about a little bit more about why that's important in just a second. But the Fed and the Bank of England, also meeting this week, aren't expected to do anything. Those are probably fairly well priced. Treasury refunding, this is obviously the story everybody is following, and you've seen a lot of notes from people saying that this is going to be the big one of the week. Depends on what the Treasury decides to do. Do they go out on the curve? Do they sell more bills? And how much do they have to sell in each of those tenors? The Powell news conference, like I said, the Fed hasn't decided to do anything, but does that mean they're done? That's what everybody's going to be looking for Jay Powell for, some sort of guidance when he has his news conference. And then the October jobs report, just because it won't have as big an effect on monetary policy because the Fed will have met 2 days before that, but it will be another piece of evidence that tells the market whether the Fed is going to have to come back or not. So we'll watch that. Now, yield curve control, this is important because the Bank of Japan has had it in place, capping the yields on 10-year notes since 2016. But look what's happened. We've broken out of that range. The bank has slowly let the band for trading widen because the markets are putting pressure on them. And as that yield goes up, that attracts more money out of other countries like the U.S. into Japan as the U.S. is trying to sell more stuff. And then here's the issuance total. As you can see, the interesting thing here, Lisa, is all the way over on the right-hand side, how volatile that has gotten as the U.S. deficits have risen. And we just got a revised deficit figure of over $2 trillion for the year not too long ago. So there's going to be a lot of sales of debt, and the market has to absorb it all. And with all these other things going on, as they said before I came on, who's going to buy all that?
Michael McKee.
And at what price, of course,
exactly.
is the issue.
Michael McKee, wonderful as always. Thank you so much. If your head is spinning, you're not alone. Dan Skelly and George Concalva are still with us, and I want to go to you. This idea that we've been playing narrative roulette. Dan, you put very well this idea that growth will take the lead in terms of the driving narrative going forward, and I want to dive into that. But George, do you agree? Do you think ultimately it's going to come down to growth and not necessarily supply and not necessarily central bank shifts in policy overseas?
I think over the medium term, I agree with Dan. I think that we are going to be pivoting towards growth concerns. I mean, we've been slowly entertaining that idea for the last couple of months, but we get these episodic moves up in inflation and energy-driven sort of spikes. But once we get past that, I do think that the growth story is going to matter more. There's the real risk that the consumers, have been outspending their savings, outspending their actual wage growth, and they're really going to be left with a pretty big bill in early 2024 to cut back on spending. That plus the corporates facing with really high interest costs and having to roll over debt, they're going to have to start preparing for that in 24 and 25. So the longer the Fed stays on hold, the more likely these long and variable lags are going to really hit home.
Dan, one thing I was talking about with our own Gina Martin Adams was that the biggest pain trade right now is the opposite, that growth reaccelerates on some level and that you start to see earnings really do better. How much is that a potential scenario that you've gamed out?
It's a scenario. We would argue it's fairly limited in nature. Once again, 5% plus from the summer quarter with all of the music concerts, all of the movie excitement, much lower energy prices at that point, much lower rates and looser financial conditions. This is a tough cocktail. And so, look, market, to your point, markets certainly can be surprised. When we look at the rally from October of 22 to July of this year, that was all about disproving the recession consensus. The correction from, call it, July to today, that's been all about disproving this notion that that interest rates, higher rates, didn't matter for valuation and in rising uncertainty around the Fed being done or not. But we would say, look, it comes back to this idea that it's going to be tough to sustain those growth rates. And again, we're still in the soft landing camp. To be clear, Ellen Zentner, as you know, our economist, made that call back in January of 22. She's been in the soft landing camp for a long, long time. And now she's penciling in barely 1% growth in the fourth quarter. So again, in our view, we have to be a little bit mindful here of taking just too much risk.
Dan Skelly, George Goncalves, both of you are sticking with us. Let's take a look at some of the stocks moving ahead of the opening bell, plus some breaking news that we just got. Here's Abigail Doolittle.
Yes, Lisa, we do have breaking news, and that is our own breaking news, that GM has tentatively reached an agreement with the UAW to settle the labor discussion. They are, of course, to end the strike. They, of course, were their last holdout, and it was thought to be around retirement benefits. I'm still looking for details in terms of what the exact deal was, but, of course, Ford and Stellantis reached a 25% pay agreement. So we will see what exactly it was that perhaps created this tentative deal. But you can see the shares of GM truly popping higher. And in sympathy, Ford is gaining as well, up 1.2%. And again, as we have more details, we will be reporting those. As for some other movers on the morning, we are taking a look at McDonald's popping on a very strong quarter. They beat comp sales in a big way by more than 1% or about 1%, 8.8% better than the estimate, having to do with pricier burgers, Lisa. We have Meta popping higher on the news that they're offering ad-free Facebook and Instagram in Europe for a fee of $9.99 to €12.99. So it seems as though some of these social media companies are really moving toward a subscription model. And then finally, WDC, the computer and storage company, is splitting to two publicly traded companies based on business lines. They also beat numbers. Sales by 8% earnings by 8%, sales by 2%, the stock up more than 20%. And again, just to recap the breaking news, GM is said to have reached a tentative agreement with UAW to end their strike, similar to Ford and Stellantis. Those stocks are popping higher this morning.
Abigail, thank you so much. Coming up, Israel entering a new stage of the war with Gaza.
We are seeing elevated threats against our forces throughout the region and an elevated risk of this conflict spreading to other parts of the region.
From Israel and Washington, D.C., our team coverage continues next.
The younger generations are more, of course, pay more attention to sustainability, and And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
It's noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
The United States will follow through on what we say we're going to do. We said that if our troops were attacked, we would respond. We responded. If they're attacked again, we will respond again. And we are vigilant because we are seeing elevated threats against our forces throughout the region and an elevated risk of this conflict spreading to other parts of the region. We are doing everything in our power to deter and prevent that.
The Biden administration saying the risk of spillover from the Israel-Hamas war remains elevated. This as Israel begins its so-called second and longer phase of war against the terrorist group, expanding its ground offensive into Gaza. The U.S. and other allies pressing Israel to be more specific about its aims as millions of displaced Gazans wait for humanitarian aid. Meanwhile, Speaker Mike Johnson expecting the House to pass an Israel aid bill this week.
We're going to move a standalone Israel funding bill this week in the House. I know our colleagues, our Republican colleagues in the Senate have a similar measure. We believe that that is a pressing and urgent need. There are lots of things going on around the world that we have to address, and we will. But right now, what's happening in Israel takes the immediate attention, and I think we've got to separate that and get it through.
Let's get to our team coverage. Bloomberg's Oliver Crook in Tel Aviv, Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. How realistic is it that what Mike Johnson is talking about could pass?
Well, it's realistic that this will pass the House. There's going to be bipartisan support largely for standing with Israel and sending over funding. This funding, though, he also in another interview alluded to this would be more than $14 billion, actually exceeding what the White House requested. The issue that's going to happen in Congress, of course, is that this does not only put Speaker Johnson head-to-head with the White House because he is trying to separate Israeli aid as well alongside what the White House wanted was aid for Ukraine, Taiwan, and other national security interests around the globe, but also with Senate Minority Leader Mitch McConnell, who also wanted to see a bigger package. So there's no doubt in my mind that Congress is going to be able to pass aid to Israel in a bipartisan fashion, but potentially this becomes a problem because he is trying to really decouple it from that broader package.
In the meantime, we've seen troops build up around Israel from the U.S. There's another war tanker that's coming over to the Mediterranean. Ali, from your vantage point, how much is Israel relying on some of the deterrence from U.S. troops? How important are some of those personnel that are coming to the region?
I mean, I think it's absolutely critical, and it's been absolutely critical since day one. And the U.S. support for Israel and the Israelis is very present in their minds. And, you know, it was a big symbolic gesture for when President Biden came here. A number of senators have come also as well. But again, and their whole stance, their whole policy has been a one-word policy of deterrence. It's don't, but it's backed up by, you say, 2 carrier groups in the Mediterranean, just behind us, in the waters behind us. And that is just right off of the coast. And those troops on high alert. And also relying on that military aid, but also the replenishing of Iron Dome, which Israel is deeply dependent on to take some of these rockets and missiles out of the sky that are falling regularly on its territory.
Oliver Crook and Marie, both of you, thank you so much, as always, for wonderful reporting. Still with us, Dan Skelly and George Goncalves. And I want to dig into the ramifications from this. A lot of people are talking about the oil ramifications. George, I want to get your sense from the spending, the defense spending, the military kind of heft that the U.S. is looking to ramp up. How much does that affect how you're kind of gaming out the next 6 to 12 months?
Look, I mean, military spending, of course, is one of the largest components of our budget and the deficit, and it's been a big driver of it, as well as interest costs, which I think is also critical to focus on that. But I don't think it's big enough that it's going to necessarily deter or reduce sort of spending. But of course, it just means more Treasury supply.
Which is a reason why a lot of people are focusing on that angle. Dan, is that kind of the angle that you're taking with it? How are you watching this conflict to try to parse the noise from the signal, at least when it comes to a market's point of view, putting aside, and it's always hard to do this, but putting aside the human tragedy, which is very real and unfolding in very much real time?
Yeah, absolutely. I mean, the tragedy is just completely awful. To your point, I think looking at the market and the economic impacts beyond that, I think, George made a good point earlier in terms of that 5% level on the 10-year not really holding. And I think you are starting to see people come in, too, in terms of this risk-off uncertainty as well, come into the bond market. So, that's the way we're looking at it. When you think about it, hopefully here, obviously not broadening out into a broader scale issue, which for the time being is the market's interpretation. Oil is up only modestly since the attack happened in Israel. When you look at, the equity market, you've seen some loosening in valuation. You've seen some credit widening, but not a ton. And so for the moment, the market is saying this won't broaden out. Iran has something like 3 million barrels of oil production a day post the sanctions loosening up. So that is certainly the key variable to watch for.
George, have you gotten that sense, too, that people are buying treasuries as a haven this time around?
Look, I mean, historically, as we've seen any sort of geopolitical tensions, treasuries have always typically benefited. But what's been interesting this time, you kind of have this weekend effect where treasuries rally into the Thursday, Friday, and then we kind of give back the gains and rates rise on Monday like we're seeing today. So I'm not really sensing a big flight to quality yet. And as Dan pointed out, and hopefully this does not escalate and it does not broaden now. Hopefully that doesn't take place. And so long as it doesn't, then I think that treasuries won't really benefit from this. But it goes back to the growth angle and what the Fed does next. And I think that this is why you've kind of juxtaposed where we are in the cycle. We're at probably pricing the best of it. That Q3 growth probably was the most growth we're going to see for quite some time. And so the 2-year, probably if there is a flight to quality, it's going to really be the front end of the treasury curve that's going to benefit more so than 10s.
When we talk about the growth story, and just to sort of wrap it up and bring it full circle, Dan, from your vantage point, what are you seeing that gives you confidence that growth really will be the story and it will be slowing?
Yeah, I think it has to do with just stock reactions, right? When you look at companies that are talking up their growth revisions, they're talking up their opportunity set, you're seeing some positive reactions. For the majority of companies that are not talking about the future in that regard, you're seeing a pretty dramatic sell-off. And oh, by the way, that was the story in terms of last quarter as well. And so I continue to think there's fairly efficient pricing going on within the equity market. Last thing I'll say, Lisa, is in a world where you have growth slowing, geopolitical tension, I think the premium, the necessity for companies to provide unique data-driven or technology-driven upside is key. So productivity is really the key underlying theme we continue to look for, both within the U.S. and globally, right? The Big Seven get all the headlines, all the acronyms, but they are the enablers of productivity. We're also looking at sectors like healthcare and industrials and manufacturing that are utilizing AI and big data to become more productive as well.
On Thursday, non-farm productivity, to your point. Dan Skelly, George Goncalves, both of you, thank you so much for being with us. Coming up, the morning calls, and later, looking ahead to the Fed, Franklin Templeton, Sanal Desai, expecting rates to stay higher for longer. That's next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that a small nation is forced to suicide.
Bloomberg. Context changes everything.
Time now for our morning calls. A look at some of the analyst recommendations this morning. First up, Raymond James downgrading Cisco to market perform, seeing risks to the company's full-year sales outlook. Next up, Truist downgrading Newell Brands to hold, expecting at least another year until the company returns to organic growth. And finally, Bank of America upgrading Chevron to buy, saying recent declines look overdone. Coming up, Franklin Templeton Sanal Desai joins us ahead of a busy week for central banks. That conversation coming up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow, moments away from the start of trading. And you can see a bit of a reprieve after what we saw last week. A pop of 0.7% on the S&P. NASDAQ also up 0.7%. So kind of pulling back basis of where we were before. Outside of stocks, you can see in the bond market, a bit of a sell-off. Basically yesterday, or last week, I should say, we saw a bit of a bid into the bond market. This year, maybe this week, year, that's where we are right now. 10-year yields, 4.89%. Crude off as people look toward a perhaps less hard escalation in Israel. And the euro just gaining slightly versus the dollar, breaking that 106 mark after losing some ground last week. One stock to watch at the open, McDonald's third quarter sales topping estimates thanks to higher prices. The CEO saying, quote, the macroeconomic environment is unfolding in line with our expectations for the year. We remain confident in our future and the strategic direction of our business. Abigail Doolittle has more on expensive burgers. Abby.
Yeah, indeed. And it's interesting, Lisa, because they put up a very strong quarter. Adjusted earnings did beat by about 6.5%. Those came in at $3.19. Sales comps came in at 8.8%, a full percent better than what had been expected. What's interesting, though, is it did come on consumers accepting higher prices, that pricier burger. But there's headlines coming out of the earnings call right now, and there's sort of some mixed messages. So they're talking about expecting to see the tough macro to continue, inflationary pressures. But they're also talking about the idea that consumers are still accepting price increases, but they're saying that they are benefiting from a trade down from pricier options. So if I'm reading this correctly, it sounds as though some consumers are willing to pay up and that the ones that are not are trading down, and it is benefiting McDonald's. On the year, Lisa, this stock basically flat, but today it is getting a pop, up about 1% off of its highs, but nonetheless the best day in about 2 weeks on this solid quarter.
Abby, thank you so much. Sticking with earnings, SoFi increasing its revenue forecast after deposits more than tripled from a year earlier. The CEO saying, quote, our deposit funding also increases our flexibility to optimize returns, a critical advantage in light of notable macroeconomic uncertainty. Here to translate what that actually means is Bloomberg's Katie Greifeld. Katie.
Hey, Lisa, yeah, SoFi is surging this morning on the heels of that report. Let's start with deposits because that's the big headline here. Deposits more than tripled from a year earlier to $15.7 billion in the third quarter. Now, analysts had been looking for $14.9 billion, so a big beat there. And not to mention, of course, more than 90% of those deposits are from direct deposit members, as the CEO called it, high-quality deposits. All told, SoFi added more than 700,000 new members in the quarter. That is a record. And of course, the company also boosted its revenue forecast for 2023. So a lot to like there. And of course, SoFi, it's been traditionally been known as its student loan refinancing business. Of course, it's since expanded beyond that into financial services. But on the topic of student loans, CEO Anthony Noto said that the resumption of student loan repayments should have a slightly bigger benefit in the fourth quarter. You add it all together, SoFi having its best day since July, and I double-checked this a few times. It's up about 66% so far this year.
Wow, Katie, thank you so much. Turning now to autos. Just breaking this hour, Bloomberg reporting that GM has reached a tentative agreement with the UAW to end the strike. Here with us to have the crack reporting on the autosphere is our very own Matt Miller. Matt, what's the latest?
Yeah, so GM is the last of the big three to make a deal with the union. Of course, all of this still needs to be ratified by union members, but GM was a holdout after Ford agreed with the union to resume work on Wednesday of last week. Stellantis over the weekend on Saturday, and that had put a lot more pressure on General Motors. GM had a lot more temporary workers than Ford. At any given time, 10% of the people working for General Motors in this country are temporary workers, and Ford and Stellantis had offered what amounts to 150% raises to those workers. That's one of the things that was a sticking point for General Motors. Also, it has the most employees that are due for retirement benefits, 300,000, so that was another one of the sticking points. But all three have agreed to give 25% raises to hourly workers, including cost, or not including, there's an additional cost of living allowance that's going to go in there, and that would amount to 33% increases in pay over the 4 years of this contract. So, as I said, it still needs to be ratified, but it looks like this strike is now over. Remember, it started on September 17th, so we're in the 7th week of this strike, and it's caused a lot of financial damage. Ford last week saying $1.3 billion in terms of damage to the bottom line.
And maybe it's now over and we can reassess just how much damage overall it has done and just how much the workers have gained. Turning to tech now, Apple is hosting an event highlighting its Macs and M3 chips today ahead of its earnings on Thursday. Ed Ludlow has more. Ed.
Week, and the market needs to decide what's more important to them, the Fed on Wednesday or Apple. That's the debate playing out on the Bloomberg terminal. We're up a full percentage point. In the event dubbed Scary Fast, we're expecting a big focus on Mac, a new iMac according to Bloomberg's reporting, and an updated version of a high-end MacBook Pro. We also expect Apple to debut its latest generation silicon, the M3 chip, its PC processor. Then move forward to Thursday when we get Apple earnings. The expectation is that overall we see a 4th consecutive quarter of sales decline for Apple. You have to go back more than 2 decades to see Apple having 4 straight quarters of sales declines. But within that, we hope to see some bright spots, particularly in expanding Mac sales, which is why tonight's event is so relevant. Bloomberg also reporting, citing third-party data, that in the first month of its sales since launch, the iPhone 15 is struggling in China compared to the previous generation iPhone 14. According to GfK data, iPhone 15 sales are down 6% when compared with the first month of sales of iPhone 14 in China 1 year ago. The expectation is that this is a kind of weaker but improving market. IDC estimates say that in the 3rd quarter just gone, Apple shipments were down 4% overall. It's a stock that the market's watching, not just because it's proportionate weighting on the index level, but because it gives us this kind of forward-looking or crystal ball lens into the health of the consumer in very key markets, Lisa. Big week.
Ed, thanks so much. And big week indeed. And you ask, what's more important, Apple earnings or the Fed? And I'm going to ask that question of Franklin Templeton, Sanal Desai, who's joining us now. So, Sanal, I want to start there. What's more important for this week? Is it going to be Apple earnings or is it going to be the Fed?
You know, something it's quite likely to be the Treasury. It's been a long time, but I think the market will be more focused on Apple. There's a limited amount the Fed can do right now, which would surprise the markets, except for doing something extremely unusual, which would be shocking if they either ruled out completely future rate hikes or actually raised rates, both of which are highly unlikely in my view.
So you say Treasury refinancing is going to be the most important. That's also coming Wednesday, and a lot of people have been mentioning maybe it's going to actually trump anything the Fed says. From your vantage point, you have been discussing your outlook for the volatile bond market, writing, quote, fixed income is delivering attractive yields again, playing its traditional role as a portfolio diversifier and income generator. How much can you double down on that without knowing the response of bond markets to a potential increase in the amount of debt that the U.S. is selling?
So, you know, the U.S. is selling a lot of debt, but I think the market is in the process of internalizing that. Can we see more of a long-edge sell-off? I think actually you probably could. But on balance, there is an asymmetry here. The extent to which you could get a sell-off is unlikely to be as much as we have seen so far. To a large extent, the degree to which we've seen what we've seen and the speed at which we've seen it, I believe has a lot more to do with where we started, which was with bond markets, which were massively overvalued and far too focused on the Fed essentially jumping in, bailing us out, and very quickly reverting the last 15 years when Fed funds was very low and you had buyers of last resort all over the place.
So at this point, when you're looking at a different kind of paradigm, how do you view bonds as a portfolio diversifier? You're saying that they are attractive right now, given how much yields have gone up. But 60-40 hasn't worked. It's not worked again. No. And a lot of people are saying if bonds rally, actually, you could see stocks rally and vice versa. So at what point can we go back to that kind of concept of diversification?
So I think what has been really difficult is how volatile the bond market has been for so long as the market continues to play off this concern about what is the Fed going to do and perhaps a continued hope that the Fed is going to dive in at some stage and admit it's made a mistake and bail us all out. I think the moment the bond market actually realizes that's not the game or the playbook that the Fed is using this time, we might settle into, dare I say it, a more boring bond market where rates are higher and there isn't any anticipation of a sudden massive rally to make capital returns. I expect to get boring returns from bond markets next year, which would be positive but boring in the sense that, 5-6% yields in investment grade quality credit. This is attractive levels. As long as you're not dreaming about getting those high single digits, double digits from high quality bonds, which people have managed to get for many years, apart from last year, this year clearly, I think that it is a good time to start considering coming into bond markets and anticipating they play that role. And in terms of readjusting, I think bond markets have gone further perhaps than equity markets have. I'm not an equity market specialist, but I think bond markets have already moved a long way in the right direction.
Which bond markets, right? I mean, because we're talking about investment grade credit, we're talking about treasuries. We're not talking about high yield. We're not talking about riskier parts of credit that have actually eked out gains this year, despite all of the red, the sea of red everywhere else. So how do you justify the idea that risk is still attracting capital at a time where people are pricing in capital costs, interest expenses that really are unsustainable for a lot of these corporate models?
I think if you look at high yield bonds, which are yielding over 9%, it is attractive. You're looking at low dollar prices, and a lot of people have an appetite for that kind of risk. And indeed, a lot of our clients do. And if your horizon is 12 months to 18 months, this is perhaps not a bad area to venture into at these levels. But it is undeniable that high yield markets are not pricing a recession. Investment grade probably is. And our preference right now probably would be to remain higher in quality and move in the direction of high yield as we start seeing spreads widening out a bit more wholesale. In a sense, certainly there are attractive single opportunities. However, as an asset class, high yield would not be our number one call right now.
Chanel, a lot of people are looking at a lot of central bank decisions, and we haven't talked that much about the Bank of Japan. I do wonder about the buyers for a lot of credit that we see in the United States. And Japanese investors have traditionally been huge buyers of investment-grade credit, but also lower-rated debt. How much are you looking at the flows to understand the dynamics, and how confident you can be in some of these investments?
I think it's a big issue. But right over there, again, for a very long time, we've not looked at supply issues, i.e. the deficit. We've definitely not looked at demand issues. And if you look between the Fed, which still, after over a year of QT, the Fed still owns over 25% of the Treasury market. If I look at just the Treasury market, the Bank of Japan is the second highest holder of Treasuries, not China, as many people think. And China only comes in at number 3. And then, of course, you have the fact that you can't exactly measure how much some of these countries are holding. But for a variety of different reasons, the Fed, because it simply stopped buying, Japan, because chances are of the next few meetings, if not already this week, we're going to see the direction in which JGB yields are going to go. And I believe they're going to go up higher, which will take away an element of support for the Treasury and IG markets. And finally, if you look at China, certainly there are fewer surpluses to essentially recycle into US Treasuries. From a demand perspective, I think both the supply and the demand picture doesn't look very attractive in the near term for Treasuries. However, Treasuries have started pricing in a lot of this. I do think there's still scope for yield curve steepening. But again, like I said, it's a bit more asymmetric now. We've come a long way, at close to 5%.
So does that mean that you're much more aggressively buying?
What we are doing is beginning to lengthen that duration. We've been short. You've watched us go through neutral, and now we are beginning to start the process of going long. We're not getting in completely long over our skis yet, because I think actually we could see Treasuries go higher from here.
Sunil Desai, thank you so much. Sunil, wonderful to catch up with you at a time where we're seeing yields very much in focus. Coming up, GM following Ford and reaching a tentative agreement with the UAW.
This contract is more than just a contract. It's a call to action to workers everywhere to organize and fight for a better life. The auto workers at Ford just won a major battle in the fight for a better world.
The latest on auto labor negotiations, the strike appears to be over. That conversation coming up next.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
This contract demonstrates the incredible power that workers have when they are not afraid to use it. This is why your national negotiators, the UAW Ford National Council, Vice President Browning, and myself wholeheartedly endorsed this record-breaking agreement. We went to Ford with the goal of not leaving a dime on the table, and we accomplished that. The UAW is saving the American dream, and we are doing it together.
That was UAW President Shawn Fain celebrating a pending deal with Ford, what he's calling a huge victory for the union, touting the contract's economic improvements, job protections, and $8 billion in plant investments. The union also moving forward with tentative agreements with Stellantis and GM. Let's get some coverage from Bloomberg's Kaylee Lyons in Washington, D.C. Kaylee, what do we know about just how tentative some of these arrangements and deals are?
Well, this is still a very new report, Lisa, according to people familiar with the matter who've spoken to Bloomberg. What we do know, though, is that the wage figure looks very similar to the agreement that the UAW, of course, first struck with Ford, that 25% increase in cost of living adjustments as well. What is unclear in GM's case specifically is what exactly the retirement benefits may look like, as that had been a sticking point, why this of the big three automakers was one of the holdouts here. But what this likely will bring is an end to the strike. Of course, this still will need to be ratified fully by the union, but this has been a long-fought battle. We're 7 weeks into a strike here at this point, as it started just in mid-September. And of course, you have a focus here in Washington on it as well, as President Biden has been a pro-union president. He has called himself the most pro-union president in history. We did get a statement out from the White House over the weekend on the agreement that was reached with Stellantis, which of course was on very similar lines. He called it a groundbreaking contract that rewards auto workers. He went on to say it's a testament to the power of unions and collective bargaining. And we certainly are seeing once again, Lisa, that it seems the hard line Shawn Fain was driving actually got the automakers, all three of them, to where the union ultimately decided they wanted to be. on the wage figure.
Do we understand, you mentioned the wage figure, and that's exactly where I wanted to go, how much of the sticking point was the headline wage number and how much were the benefits and some of the other asks by the UAW?
Well, we know a lot of those asks, Lisa, are just more difficult for the automakers to swallow, considering the legacy that comes with them. A lot of the things that the union initially was asking for in terms of pensions and retirement benefits are some of the very same causes that led to the bankruptcy of two of these companies back in the post-financial crisis era. So some of that was more difficult. And again, that retirement part of the equation, we understand to this point, at least to this morning when we got news of a tentative deal being struck, was one of the real difficulties for GM. So we'll look for more details on that. The wage figure is really where we saw a lot of the headline movement over the course of these negotiations that have been, almost 2 full months now. The idea that the union came out and initially wanted 40%, slowly worked their way down, but our reporting here at Bloomberg had been 25% is what the union was looking for. As of just about a week and change ago, they had gotten the automakers up to 23%, and it seems they finally closed that bit of distance. But certainly on the headline, especially considering those are pretty big headline figures, but these are workers who have said that they have not had their wages keeping up with inflation for a long, long time now. Wages was something they were really pushing on.
You're covering this from the viewpoint of Washington, D.C., and I do wonder how much is this going to bear into the election. It is still a while away, and if it's already concluded, does this mean that the union goes back to being more Democratic, or does it sort of be more purple the way that it was during the election prior?
I think when we're looking at the UAW, Lisa, you almost have to look at union membership and union leadership, because we know union leadership, Sean Fain, is no fan of former President Donald Trump, who, of course, looks like he may very well be the Republican nominee. And yet the endorsement has always hung in the balance that though Biden was invited to strike at the picket line earlier on in Detroit with these automakers, there were union members, at least theoretically, who may have been more supportive of Donald Trump. So certainly the idea of the labor movement is going to factor in this election, but also just in terms of thinking about the economic consequence. For President Biden, yes, he wants to be pro-union and have the support of unions going forward into 2024, but he also needs a strong economy, as he consistently has struggled in that department. And the longer the strike went on, the greater economic impact it could potentially have, as well as potentially disrupting the EV transition he has pushed so hard on.
Well, exactly that. President Biden coming out just moments ago and saying, I think it's great about union and car maker deal. So I think it's great about the union and car maker deal. And this sort of speaks to what you were mentioning before, Kayleigh, that he is touting himself as the most pro-union president ever. Just finally, on that point of the electric vehicle transition, do we have any sense of what the thought is about what this does to that and to the wages on that front, in the EVs front, that weren't necessarily as involved in some of these negotiations?
Yeah, we'll have to look into the details of the contracts for that, Lisa, but really what it comes down to is not just the wages, but the idea of job security, that as these automakers are transitioning from the ICE era, the internal combustion engine era, to electric vehicles, in which some of the jobs just are likely seen as not being paid enough, that it's just going to be different. Job security going forward was a really big sticking point here, and that's actually one of the arguments you were hearing the likes of Mary Barra over at GM make, the idea that they have to retain profits so that they can continue to invest in that future, but keep union jobs in that future. And that has been one of the difficulties. And again, Lisa, we'll bring more details always as they come.
Kayleigh, thank you so much. As always, coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community. When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. 26 minutes into the trading session, you can see the gains building. 1.3% gain on the NASDAQ. S&P gaining by more than 1%. Yields still higher, but coming a bit lower on the day. As you can see, it was up earlier more than this. Time now for your trading diary. You need to be watching this week. President Biden speaking at 2:30 Eastern on his executive order for AI protections. Tuesday, we'll get U.S. consumer confidence, plus the BOJ's rate decision. Wednesday, an FOMC rate decision followed by Chair Powell's news conference. Thursday, U.S. data includes jobless claims and durable goods, plus, of course, Apple reports earnings after the bell. And Friday, the October payrolls report, and we didn't even mention the refinancing agreement on Wednesday, which may end up being the most important event. This was Countdown to the Open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Stocks moving higher this morning. Coming up, we're going to check in with Mick Mulroy, co-founder of the Lobo Institute. You can talk to us about the latest on what is happening with the Israel-Hamas war. Gabby Coppola joins us. She's an auto industry reporter with Bloomberg News, discusses GM coming to an agreement with the UAW. Seems like everybody's getting back to work there, which is good. Rob Williams, Chief Investment Strategist at Sage Advisory. He's going to join us and talk to us about his market call. But first, let's kick things off with John Tucker in a Bloomberg Business Flash.
All right, Matt and Paul, the market rebounding following a pretty difficult week that saw both the NASDAQ and S&P 500 slide into correction territory. A handful of strong earnings reports this morning, including members from Dow component McDonald's. That included strong sales growth at Cent shares. Up earlier, right now, they look like they're dead flat. Fintech company SoFi Technologies posting a large revenue beat. That was up over 4%. But despite the rise in stocks right now, investor sentiment has been pretty bad, at least according to Lori Calvasina at RBC Capital Markets.
We've really seen a pretty dramatic pullback from the bullishness that we saw in place in mid-August, if you look at the AAII survey that comes out every week. But we haven't really seen, kind of a collapse down towards levels that would suggest that investors are overly pessimistic. So I think there is still risk ahead for that to get worse.
Right now, S&P 500 up 1%, 4157 on the index. The Dow up 290 points, a rise of 0.9%. The Nasdaq 100 up 176 points. That is up 1.25%. The 10-year yield 2 basis points higher, right now at 486. Back to the office. Not so fast. New York Times tech workers, they plan to mount a half-day strike this afternoon, accusing the media company of trying to unilaterally force them back to the office. Is there any other way?
Exactly.
I guess they were supposed to negotiate. This actually, I'll go by there just because I want to see the picket line because they're going to wear their Halloween costumes.
Okay. Keeping it light.
Not exactly the Teamsters, but you know.
Right, exactly. No, all right, very good. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube. So head over to youtube.com and search Bloomberg Radio. Bailey Lipschultz joins us. He covers all the markets for Bloomberg News. He joins us here in our Bloomberg studio. Bailey, what are you looking at? A lot of green on screen today.
Yeah, good amount of green. Best performer in the S&P 500 this morning. Western Digital right now up more than 10%. That coming after results. But really, the big driver is that the company will separate into two businesses, ticker WDC right now up 10.5%, separating into two publicly listed companies. This coming after the deal with Kioxia fell apart. So this is a company that will separate into its HDD and flash businesses.
This is awesome.
Which is
bankers getting paid. Getting paid.
It's the year of spinoffs. I was meeting with an advisor this morning, and he was like, spin.
So, all right. So Flash tells me this is a chip maker. What's the other business between its what and Flash business?
HDD.
HDD. That's a kind of chip, I guess.
I don't know.
It's
high definition.
It's focused on high capacity memory to cloud data centers.
This is how it worked. The M&A banker didn't get the deal done. Calls up his restructuring guy. I think you got to go down and let's make a pitch. Come on down with me. We'll go to Plan B.
Yeah,
Boom.
The backup from a deal, more consolidation. Well, what if we just get more companies listed?
Yep, that's exactly. All right, why not? Usually in tech you see these guys getting bigger and bigger, but if one business has a higher multiple than the other, sometimes it makes
sense. And that's really, this is an expectation for this spin-off separation in the second half of next year. One of the things analysts have been calling out is that both businesses should be on better footing come second half of 24. Another outperformer, Meta Platforms right now up 3.5%, ticker META. This coming after plans to launch an ad-free Meta and Instagram subscriptions in Europe, so allaying some of those regulatory concerns over how they collect users' data. I don't know, Matt, Paul, I don't know if you guys, but I don't know that I would spend €13 a month to have access to ad-free Facebook.
No, I mean,
No,
absolutely
not me. But there are some people who spend a lot of time on Facebook.
Well, the Europeans in general, European consumers in general, are much, much more concerned about advertising on digital platforms. I mean, they have been. That's why the regulations, one of the reasons the regulations are so tough over there is because consumers really don't like the intrusion of ads on their digital media, whereas here we're like, whatever.
I mean, you think about when is the last time have you ever read the terms and conditions on any app or anything that you...
Never, ever in my life.
Word for word.
I always go, how does Chipotle know how much money I make? And they're like, do you use an app? I say, yeah. Is it linked to your bank account? Sure. Well, there you go.
But Chipotle knows your general income?
Yeah.
Amazing.
They know everything. And they talk about, that's why a lot of these companies, consumer-facing companies, whether it's big box retailers or restaurants, they'll say, oh, we're seeing more spending from this demographic or people with this income band, and that's because they know everything about you. On the flip side, though, the second worst performer in the S&P 500 this morning on semiconductor, ticker ON, down 17%. Weak forecast for the fourth quarter, missing expectations. William Blair saying the outlook missed across the board, so obviously that's not great news for the company, and that's why you're seeing it markedly underperform. Again, the actual worst performer, which changed their name, Revvity, ticker RVTY, used to be Perkin-Elmer. They missed expectations, also down 17%. That's leading to some weakness in the health tech, life science tools space. But again, broadly speaking, we are seeing big tech rally.
I'm calling out just for Matt, because I know Matt loves this. McDonald's, killer quarter. Again, people are eating the burgers. They're paying more for the meals. So I walk in and get my number one with a Coke, which I've been doing since like 1970-something. And it works but there's a million other items on there, and people are buying them.
What's the number one with a Coke?
Quarter pounder with cheese.
Ah.
Ooh. But if you go to Europe, it would be
a Royale
with cheese. Why?
Because that's exact metric system, yeah. That's a shout out to Pulp Fiction. Bailey, you know that, right?
Yeah.
Okay, I'm just checking because Eric Molo, our producer the other day, he didn't know who the Low Ranger was. He didn't know. And a lot of my references are falling flat lately, you know? But I'm glad Pulp Fiction still holds.
Exactly. All right, Billy, thank you so much. We appreciate that. Billy Lipschultz covers all the markets for Bloomberg News, and we appreciate getting an update there. Let's check in with our next guest, Mick Mulroy. He's a co-founder of the Lobo Institute, former paramilitary operations officer at the CIA, and former U.S. Marine infantry officer for 16 years, so we thank him for his service. Mick, it is bad in the Middle East, and it looks like it's going to get worse. What do you believe Israel should do at this point?
You know, I think I heard that every day when I came into my office when I was responsible for the Middle East. And it's not always that bad. But you're right. I agree with you. It is bad right now in two ways. Obviously, Israel has to go in and destroy the enemy that attacked them on October 7th. But the people of Gaza, the Palestinians, also need to be allowed basic necessities such as food, water, and medicine. And it looks like that is two things that we're going to do everything we can, we being the United States, to make happen. Very difficult in a situation like this, but necessary. And I think we're going to do it.
I wonder about the actual tools and technology that modern armies use, because we see so much reporting about Hamas having this underground tunnel network, which sounds terrifying. But of course, there were such underground tunnel networks in previous wars, decades and decades ago. So do we have ordnance that can reach deep underground and destroy a network of tunnels?
So yes, the problem is when those tunnels are under buildings. There is ordnance that has the ability, it's time delayed, so it penetrates into the ground before it detonates and then causes this concussion that can collapse tunnels. Now, if they're some of the tunnels in Gaza are up to 200 feet underground. It won't work for them. And then on top of that, so subterranean fighting, to your point of your question, yes, we've been doing that for a while. But the complicated factor in here is normally you could just use combat engineers, seal them up, explode ordnance above them, collapse them. But now we have up to 220 plus hostages that might be in those tunnels, and you can't do any of those tactics that we've done in the past, or that has been done in the past when it comes to subterranean warfare. You have to go mile by mile, and there's over 300 miles to try to recover these hostages at the same time you're fighting the enemy.
This brings up another interesting point, and it's like, I guess, a moral battle that any army is going to have internally. At what point do you say, we do not negotiate with terrorists and we're going to move ahead with our main aim, which is destroying Hamas? You know, essentially, I mean, is it even possible to say we will sacrifice these hostages in order to achieve our goal?
So it is possible to do that. I don't think it should be done or will be done. Ultimately, militaries are there to protect their civilians, just like our military is to protect the United States and everybody in it. So although it makes it much more complicated, and quite frankly, it brings a lot more risk to the force to try to recover hostages, that's part of what we do, and I think they will focus on doing both. It would have been much better if,
I mean, Nick,
the
the problem is
out.
obviously in order to try and get those 220 hostages back, you could risk losing exponentially more soldiers.
That's you will risk losing more soldiers. Yes, there's no easy decision here, but every time you send in a hostage rescue force, you are risking the force to rescue, in most cases, one individual. And it's a mission failure if the hostage taker just turns and shoots a person at the last second. But you're still risking the entire force in the process. And sometimes they use it as a way to lure in forces to attack them. That happens not all the time, but certainly in most hostage rescue situations. Here it can happen up to 220 times. So because they could be separated, they're not going to be in the same place. And it's going to be extraordinarily difficult. And it's something that the IDF is grasping right now, I think. And hopefully, and I think we do have members of JSOC and the CIA on the ground helping them. But they have very effective special operations. And this is just a very complicated military problem.
Mick, what do you believe at this time is the risk of this becoming a more regional conflict, whether Syria or Lebanon? Where are we in that regard?
So I thought it was high, and then listening to the Iranian statements yesterday, I think it's higher. So that is one of the reasons why I think the United States has been so proactive of moving now a second aircraft carrier strike group to the Eastern Mediterranean, something that's unprecedented. Now there's the 26th MU, the Marine Expeditionary Unit, is being retasked there. And I think you're going to see more and more resources coming to the region because we think Iran wants this to expand. Let's hope it doesn't. Let's hope the United States doesn't have to get involved. But it looks like it's heading that way. And Iran can easily make this go from a one-front war, if you will, to a 3-4 front war. And if they get involved directly, then this is going to be a regional war.
So where do the other countries align? If the U.S. is drawn in to a broader regional conflict, what happens? What do the Saudis do? What do the Turks do? They're in NATO. Are they on our side against Iran?
So when it turns into a war against Iran, if that's what happens, let's hope it does not. That would not be good for anybody, the region or the United States, and certainly not Iran. Then the Saudis and all these Gulf states who do have some political ties and sympathies, certainly, to the Palestinians, it could shift quite a bit because they are no friends of the Iranians. In fact, most of the Iranian efforts have been targeted toward them. If you think about the Houthis in Yemen toward Saudi Arabia and the UAE. I don't think they'll become actively involved, but certainly that'll change the calculus for them if this becomes a Israel, Iran, and U.S. Conflict that goes well beyond Gaza. That said, it is not going to be in anybody's interest. This is going to be very destabilizing. It's going to ruin economies, and it could be very substantial. If you think about it, there's several nuclear-powered countries that would be involved in that, and Iran is on the precipice of getting their own nuclear weapon. And I don't know what that status is now. I'm not of the government, but it could be very close. And that's something they could be racing toward right now.
Mick, Prime Minister Netanyahu had an interesting weekend over social media, seemingly putting the blame on the intelligence apparatus of Israel for the October 7th attack. How do you put all of that into context with what the military is trying to achieve here?
So I believe in the old adage, the buck stops here concept. You're in charge. You're in charge for everything that happens or fails to happen. It was obviously an intelligence failure, but more than that, it was a security failure, because even if you did not know that they were coming, the reaction times, quite frankly, from what I've seen, are unacceptable, especially in a country the size of Israel. And that's saying something. But it's also important to point out that we had a pretty massive intelligence failure, and I think we had the best intelligence services in the world on 9/11. So it's less about poking fingers and more about, that needs to be addressed by Israel. I know they know this. It's not something that it's a surprise to them. After that, I think they will. They just don't have time to do it now. It's going to have to be on their to-do list for right after this current conflict is over.
So, Mick, just as observers here, should we set in for a long, grinding type of action here, or is there any scenario where there could be something quick, decisive, measured in days, not months?
So there could be, but I think that would require the Israelis changing their objective. If they want to destroy, which is a military term, destroy Hamas, that makes them essentially completely ineffective at carrying out their military, although in their case, terrorist mission, unless they reconstitute themselves. If that is still their objective, it's going to take months and months to do that in Gaza. If you look at Mosul in 2016, it took 9 months, and there was only 9,000 fighters. Gaza has 40,000 fighters. And then if they want them to prevent them from reconstituting themselves, they're going to have some kind of occupation. They can't just leave and let it go, because Iran will move right in, pick up the pieces, and start arming them and all that immediately. So they're going to have to be some kind of force. Maybe it's not Israelis. Maybe there's an international force, peacekeeping force, that can move in to help with the rebuilding of the area, and of course humanitarian assistance, but also to ensure that Hamas does not reconstitute itself. That's something that's actively being discussed. Much easier said than done, but something that I think should be looked at.
All right, Mick, thank you so much for joining us. Really appreciate getting your perspective, your analysis. Mick Mulroy, he's a co-founder of the Lobo Institute. Lots of experience in that part of the world. Former power military operations officer at CIA, former U.S. Marine infantry officer, senior fellow at the Middle East Institute. So a lot of experience in that part of the world and with those types of geopolitical challenges. Looking at the markets right here, the S&P 500, that's up about 0.6%. The NASDAQ's up about 0.9%. A little bit off the highs earlier this morning, but still showing pretty solid performance. Yields up 5 basis points on the 10-year to 4.89%. We'll have more coming up. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
You got it, Paul. General Motors has reached a tentative agreement with United Auto Workers. Sources tell Bloomberg it includes a 25% hourly pay raise plus cost of living allowances over the more than 4-year contract. The UAW has already reached tentative deals with Ford and Stellantis. Right now, GM shares are down about 1%, Ford down about 2%, Stellantis is up just a fraction. Meanwhile, striking SAG-AFTRA actors could be nearing a deal with a group representing Hollywood studios. We have details from Bloomberg's Steve Podisk.
Deadline reports sources tell it both sides have expressed confidence a deal may be reached within days. Although the situation remains fluid, actors and studios have reportedly gained significant traction on bridging the gap over success-based compensation for streaming shows and their casts.
Now, the actor strikes are causing Walt Disney to make more adjustments to its movie release calendar, delaying 3 films that were scheduled next year. Bloomberg's Gina Cervetti has that story.
The company is also removing another 3 from the lineup altogether. A Snow White remake was delayed by a year to March 2025. Pixar's Elio, that was also due out next March, will instead be released in June of 2025.
Now, checking with Disney right now, shares are up just a fraction. And Charter Communications' dispute with Walt Disney, well, it caused quite a setback. The company says it lost about 100,000 cable subscribers after customers were unable to watch ESPN and major sporting events like the U.S. Open, as well as other Disney-owned channels for 10 days at the end of the summer. Charter shares right now, they're up about 3%. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. We have this Bloomberg Business Flash. The major stock averages, they are higher in the early going. You have 10 of the 11 major industry groups in the S&P 500 are higher. Best performing group, that belongs to communication services, and that's where you can find Meta Platforms and Alphabet. The S&P 500 confirmed a technical correction on Friday. It slumped 10% from its July peak. And this week's going to be a busy one as we get a Fed decision, important economic inflation data, as well as the final big week of earnings. And Apple event later today. They're going to unveil 2 new Macs as well as processors. We are shaving some of the earlier gains. S&P 500, 22 points higher. That's up 0.6%. 4140 on the index. The Dow Jones Industrial Average up 248 points. And the NASDAQ 100, 76 points higher. That is up 0.5%. And the 10-year yield right now, 6 basis points higher. We are at 490. And we check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. All right, it looks like we are moving towards labor peace in the auto industry. GM reaches tentative agreement today with UAW, ending a 6-week strike. Let's break it down with Gabby Coppola, auto industry reporter for Bloomberg News. Gabby, this seems like, I guess, the last deal to get done here. Anything unusual in this deal relative to what we saw from Ford and Stellantis?
Not yet. We don't have enough details to say if there is big, differences. I think obviously they followed the pattern on wages, 25% over 4 years and 8 months plus inflation protection or inflation adjustments. I think that money for retirees had been one of the big sticking points towards the end for GM, and that's why you saw the UAW actually expanding their strike this weekend against GM before it got done. But I think temps and retiree, money for pensioners and retirees were the sticking points, and we'll see what that extra little strike did, if that bumped GM up to be in the same place as Ford and Stellantis or not.
Right, because walk us through the differences between these 3 auto manufacturers. They're all big, right? But GM has a lot more I think, retirees to consider. GM has, for example, more temp workers than Ford, maybe a little fewer than Stellantis. So there are differences between these three companies.
That's exactly right. I mean, I think once Ford set the pattern on wages, that was the pattern, but then you get into some of these other issues, exactly what you mentioned. GM has much bigger pool of retirees than, say, Stellantis does. But Stellantis, has fewer plants in the U.S. Than Ford and GM. Ford has the most. And the temp worker issue, that was an interesting one because Ford has always kind of been the Boy Scout here of the D3. Like they always like to brag that they have more American, workers and, full-time workers than their counterparts. And that's true. So it was kind of less painful for them to bring up the temps than it would have been for GM and Stellantis. So they were, I think they're probably happy to see GM and Stellantis getting pushed to where they are in that regard.
Because Ford had a GM has like 10% of its workers at any given time are temps, right?
Right.
And Stellantis a little more, and Ford far fewer.
Ford was like around, what we reported going into the strike was Ford was around 3%. I think GM was around 9 or 10%, and Stellantis was like 12%. And Stellantis, I think one of the things that really strikes me, Matt, just looking at this, what the contract they got, it is like they completely turned the tables. The companies were really used to going into these things and squeezing the union harder and harder. Stellantis wanted even more flexibility to use more temp workers. They wanted to eliminate, thousands of jobs. They wanted to close this engine complex in Trenton, Michigan, Toledo machining, and none of that happened. I mean, Stellantis put a vehicle back in Belvidere, Illinois. That was a huge deal because that was a major issue for the UAW. That was, 1,300 people got laid off this spring when Stellantis idled that plant. And it really did not look like it was coming back. So I think what really strikes me is just how much the union really turned the tables on the companies. It went from the union, really getting pretty concessionary, modest wage increases, things like that, ever since the bankruptcy, ever since 2007, really, even before the bankruptcy, when they started making cuts to kind of help the automakers survive what was coming. And this is what Bain said he was going to do. And, he did do it. Like they really, I'm not saying they got everything they wanted, but they got a lot. And they definitely beat back a lot of the concessions that companies were looking for.
So what did turn the tables there, Gabby? Was it just simply catching up and trying to get back what they had conceded over the last 12 to 14 years? Or has something fundamentally changed within that relationship?
I think it was a few different factors. I mean, one, I think the automakers knew they needed to pay more because of inflation, right? I mean, I always remind people of this, that, we saw during the pandemic, the labor market's been very tight ever since then. Inflation's been really, the highest, and, interest rates are high. That was really squeezing people. I mean, don't forget a temp worker, take Stellantis, for instance, they had the biggest number of temp workers. Those people made $15.78 an hour. And then you think about all the inflation that happened over the past couple of years, the non-union employers, Amazon, Starbucks, everybody was raising wages to respond to the tight labor market and inflation. And the car companies kind of hadn't done that. They hadn't paid the bill, right? The bill was coming. So I think for sure part of it was like they legitimately knew they had to pay more. I think part of it was, yes, after 2008, people really felt like they deserved. The mentality of the union is that we gave these concessions to you guys to get you through. They weren't supposed to be permanent, right? And the car companies were like, no, this is our new business model. This is our new labor cost model. This is our new operating.
How
this is
quickly
the new
they
normal.
forget. By the way, Gabby, is some of this also, for example, Stellantis, it's easier for them to agree because, as you say, they don't really make that much stuff in this country. And if somehow magically Dodge and Chrysler become brands where they're going to produce more cars, I mean, that doesn't seem like it's going to happen now.
No.
They'll make them in Canada or they'll make them in Mexico. I mean, this is essentially the union sealing its fate in terms of not going to add any extra capacity in the U.S. for a few years, are we?
Well, I think, that is certainly a concern, I think. And I've even heard that concern expressed from some people in the labor movement, like, oh, I hope we didn't do so much that we're now going to shield ourselves from future investment. I'm not. I am not going to rush to judgment. I'm going to wait and see what happens. I look forward to doing a lot more reporting in the coming weeks, talking to people on the executive side to say, what are you guys going to do here? But yeah, it's not. It's true. People want low labor costs. On the other hand, you've got the Inflation Reduction Act. You've got all these incentives. And I didn't mention, but obviously, I think the biggest thing was Sean Fain and new leadership at the UAW. This is a very different, more hard left, more, just really more radical, more militant.
Well, and I wouldn't use the term unbribable, Gabby, because I wouldn't want to make that allegation. But past union leaders are in prison, right?
Yeah, absolutely. I mean, absolutely. I think that, I would say that some things that were great that the Sean Fain and the leadership did was they brought this level of transparency to the union and to the process of negotiation. I mean, Fain was on there every week doing these Facebook Live, updates, speaking directly to the membership. In the past, this was something that happened behind closed doors with a few group of men, and they would come out and be like, here's the deal. And there was a lot of mistrust between the leadership and the membership, especially once the, corruption scandal started. So in some ways, you kind of had to have this clean break with the past and do things really different. And I think that Spain just really won the trust of people, and it feels like a much more democratic union and honestly like a healthier union just from an engagement standpoint. And I think that gave them a lot of power, I don't think they could have gone on forever, right? People were starting to hurt, especially people who've been on strike since September 15th, at the Jeep plant, stuff like truck plant in Michigan for Ford. People were getting tired,
right?
For sure.
Hey, Gabby, do you think the UAW takes these wins and maybe it goes down south to some of these non-unionized plants?
That's definitely there. 100%. That's the plan. I mean, last night, Sean Fain, when he was going over the Ford details, he said it's not just going to be the big three; it's going to be the big 4, 5, 6. Meaning they have the whole mentality
BMW.
of these contracts was this is our calling card to the non-union plants.
Fascinating. I wonder when we get more details if we're going to find out cool stuff like what cars is Dodge going to build? What cars? I mean, is Chrysler only going to have the Pacifica, or are we going to find out plans for future products?
Chrysler has shown a lot of. Chrysler is really trying to go beyond, the minivan. We'll see what the actual industrialization plan is, but I mean, they brought out a lot of really sleek-looking kind of crossovers, mid-range, kind of close to hopefully more affordable, kind of stylish, that would kind of appeal to, I think, to younger people, that kind of, you don't necessarily have kids, 20s and 30s.
Like
that's
a Crossfire.
What they're going after.
The Crossfire was pretty cool at the time.
Yep. All right. All right, Gabby, thank you so much for joining us. Gabby Coppola, auto industry reporter for Bloomberg News, joining us on this GM reaching a tentative agreement with the UAW, ending a 6-week strike. So your Dodge Challenger with the Scat Pack was actually made in Canada, right?
Yeah.
Whereas my BMW was made in Tennessee.
That's right.
So I bought an American-made car.
All the BMW X cars, so all the SUVs are made here in America.
All right, so I bought Americans. How about that? All right, right now let's head down to Washington, D.C. World and National News with Amy Mars.
All right, thank you, Paul. Israeli Prime Minister Benjamin Netanyahu warning of a long and difficult war against Hamas as the conflict enters what he calls the second phase, calling it a war of independence for Israel. We asked Elliot Ackerman, a former White House fellow and Marine veteran of the house-to-house fighting in Fallujah, what happens if Israel is successful in extinguishing Hamas?
I think the question is now, what do you do in Gaza? And do you face a protracted insurgency in Gaza? And I think when it comes to this idea of normalizing relations in the region, that's when we start to get into questions of diplomacy.
Former White House fellow Elliot Ackerman says it's important to look at the politics behind the war, including talks of a peace deal between Saudis and Israelis. The relationship between FTX and Alameda Research is under the microscope as the trial of Sam Bankman-Fried continues. He returns to the stand today and will likely face a bruising cross-examination from prosecutors after his testimony on Friday, where he admitted to mistakes but said he did not commit fraud. The case against Bankman-Fried centers on allegedly fraudulent transfers of billions in FTX customer funds to an alleged hedge fund, Alameda Research, in which he held a 90% interest. It is not likely you'll ever be forced to wear a COVID mask on an airplane again. The Senate has passed an amendment to a spending bill that bans federal funds from being used to enforce face covering mandates on airlines, trains, and buses.
We've learned a lot of lessons as a result of the politicalization of science and the mixed messages that people got during the pandemic.
Senator John Cornyn of Texas, who voted for the amendment, called it a victory for personal freedom. Masks can still be worn, of course, but it's up to the individual. They can't make you wear one. It's been nearly 1.5 years since a federal judge ended the Biden administration's mask mandate. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen, but we have paired some of the earlier gains in the markets after the S&P 500 fell into a correction on Friday. Starting the week higher, traders are busy eyeing the week ahead, containing jobs data. We're going to get central bank action with Jay Powell and Company, and then Apple earnings as well. Right now, SoFi Technologies boosting its adjusted net revenue guidance for the full year, beating the average analyst estimates. That is among the earnings we got, up 2.4% the stock right now. The benchmark 10-year Treasury, that's 7 basis points higher, right now at 4.90. And Barry Bannister at Stifel Nicolaus says bonds have been in the driver's seat for stocks.
Well, I do think that the yields and the re-rating of yields has led to the de-rating of equities, and that's been a big issue for the market to deal with.
Right now, the S&P 500, 22 points higher. That's up 0.5%, 4138 on the index. The Dow Jones Industrial Average is up 250 points. The NASDAQ 100, 82 points higher. That is up 0.6%. According to the latest Bloomberg MLive Pulse survey, weight loss drugs seen as more attractive than artificial intelligence. Novo Nordisk, the maker of the diabetes treatment Ozempic and Wegovy, was picked as a better investment opportunity by 57% of those surveyed versus 43% saying AI chip leader NVIDIA was the better choice.
All right.
So there you go.
All right.
I guess it depends on who you...
NVIDIA's already had a huge run up, but lately when I hear survey results, I like to look a little bit deeper into the survey and see, because there was a survey a couple weeks ago that said, Trump is a shoo-in for the 2024 presidential election. Then I saw that only 61 people took the survey.
Oh, okay. So not very representative, perhaps.
Well, then the Fed actually did a survey. Torsten Slok sent around on the weekend. The Fed did a survey on student loan payment resumption and how seriously it would affect consumer spending. But then I looked and I saw they had 1,000 people, only 250 of them had student loans, only 150 of them had student loans that have been suspended in terms of payments. So, then the pool gets smaller and smaller and smaller, and I don't know what you can take from that.
All right.
Well, I would say the MLive Pulse survey is scientifically, sound.
I believe you.
I believe in John Tucker. Thank you very much. We appreciate it. Matt Miller, Paul Sweeney live here. As John was just reporting, it's been interest rates kind of moving these equity markets. The Fed may be standing pat. We'll find out in the next couple of days, but the market's definitely moving rates higher. It's been a challenge for equities. Let's check in with our next guest and get his thoughts here. Rob Williams, he's a managing partner and chief investment strategist at Sage Advisory. So, Rob, again, equities, up until today, it had, kind of a challenge really since, kind of late summer performing here in what has been a rate environment of ever higher rates here. How do you see the markets here? How are you guys thinking about the remainder of this year and into next year?
Yeah, you're exactly right. Thanks for having me, first of all. You're exactly right. It's really what's your rate call? What do you expect for rate is going to be a big part of equities. And obviously, how big the economic drag of this tighter policy, does it finally manifest itself in some sort of landing of some sort? But I'd like to say, near term, some of this volatility, this out of bounds rate volatility is going to ease, but it's not going to be this week because, like you said, we've got a ton of market moving stuff. FOMC, that has a potential to be a non-event, although I would say they need to tinge a little bit more hawkish, at least acknowledge the strong data, keep the idea of a December hike out there at least. And then you have payroll and Apple earnings. But the big one's really the refunding. The issuance needs is what's been pushing up the back end of the curve, building some term premium back in. And that's what's gotten the equity market a little more shaky these last several weeks. So that one really has the potential, if they continue down this path of not only, they have to fund the deficit, so there is a tremendous amount of issuance coming, we know that. But if they continue to term out that refunding into, longer dated coupon issuance, that's going to continue this steepening of the curve. So that's a big one this week. If they back off that a little bit, or if they keep on the same aggressive path, that will dictate, I think, the markets this week.
Rob, is it, we have such incredible data looking back on the third quarter GDP, about 5%, unemployment still at kind of the lowest level it's been since the 60s, right?
Right.
Is there some, and I mean everything, right? Consumer spending, new home starts, et cetera. Is there some data that we're all looking at to tell us the economy is going to fall off a cliff in this quarter? Because that seems to be everyone's attitude. That seems to be consensus.
Consensus is built that way. There's pessimism built into the what economists are forecasting, but it's not manifesting itself. So it actually makes the bar more difficult to disappoint. If the expectations are disappointing, the markets hold steady, then equity markets are somewhat supportive. The difficult part is this savings cushion, this fiscal cushion that we've created. It should be getting tapped out. This tighter policy, we're seeing credit conditions, all these things that should have told us we should be very close to a recession are still flashing that. So we're just used to, lately, we're used to these expansions ending with a thud and a flash, right? And sometimes they fade away. And I think this is more of a fade away one that we're not used to. I think the consumer will fade. It's just taking a little bit longer. And then I don't know if the market's fully prepared for that soft recession, call it, sometime next year. They're starting to get more prepared for it because rates are pushing, have held us in check, but I don't think they're fully prepared for that. So we still think the right move is to position as if you're at least in a late cycle kind of environment.
So we've had about half of the companies in the S&P 500 report earnings, Rob. What's been your takeaway? Anything surprising you here?
They set the bar fairly low, so I had a feeling that it was going to look pretty decent. We've got a long way to go. I tell you what surprises me, or maybe not surprises me, but it's, to your point, what data should we be looking at? The guidance has been disappointing. The number of companies kind of lowering guidance and key words that are coming out is like we expect lower volumes and we're worried about inflation if in some of the dialogue. So the guidance is as low as it's been in 2020. So that troubles me. Just like GDP, the past is the past, and we really got to think about the future and this drag going forward.
So what are we thinking about here, Rob, in terms of positioning here? For late cycle, what does that mean to you in terms of kind of asset allocation, sectors you want to look at?
Yeah, I mean, as scary as it sounds for bond investors, I think you should be thinking, bond, you're getting paid a lot more. You think you should, if you have an extended duration or added bonds, it's even a better time to do it now. The curve's steeper. You've gotten more yield. I think you should revisit the idea of extending duration and putting more bonds in your portfolio. You're getting 0.5% every month in carry. This is not 2022 where you're getting, it took 9 months to get that amount of yield. So that's step one. And then, but be defensive, less, the only place I would be short duration still is in the credit allocation, your bond exposure. And then equities, your traditional late cycle positioning is these defensive sectors. The problem is a rate correction hurts those type of sectors. So one sector that is a little less rate sensitive, but defensive is healthcare. So we like healthcare. We like some of the lower vol sectors. Definitely we tamp down some of the mega cap growth. We know the market's very skewed and top heavy, so don't look like a market cap index in your allocation, maybe look more like an equal weighted. And then look overseas to markets that are heavily discounted the US, which is most of them, but have at least okay economic prospects, maybe not core Europe, things like Japan. So it's a difficult market to navigate. I think you should be defensive overall, but you just have to be careful how you're defensive, not also lining up against rates.
Right. All right, Rob, thanks so much for joining us there. Rob Williams, he's a managing partner and chief investment strategist at Sage Advisory. Looking at these markets, still positive here, but giving up a little bit lower off their intraday highs. S&P 500 up 0.5%. NASDAQ up 0.6%. We're going to have more coming up. This is Bloomberg. Good morning. to get some company news right now with Lisa Mateo.
Hey there, Paul. The last of the big three automakers has reached a tentative deal with the UAW. Sources tell Bloomberg that the agreement with General Motors includes a 25% hourly pay raise, plus cost of living allowances over the more than 4-year contract. Bloomberg Detroit Bureau Chief David Welch says it still needs to be ratified.
Once that process is in place, then the companies can kind of start looking at where they're going to invest and how quickly they're going to ramp things up. And I think it's going to be tough for them to do, just kind of cranking up EV production and all this other stuff. It just takes a little bit of time to turn the ignition on these things.
Now, the UAW has already reached tentative deals with Ford and Stellantis. Checking in right now, we have General Motors and Stellantis. They're down a fraction. Right now, Ford is down nearly 2%. Meantime, things are looking up at Toyota. Bloomberg's Steve Potisk has that story.
The world's biggest car maker is on track for another year of strong gains thanks to robust demand and improving supply conditions. Toyota's global sales climbed more than 8% in the April to September period from a year earlier to a record more than 5.5 million vehicles.
Now, it's not doing much for shares. Toyota shares right now down about 1%. Honda Motor said its global output in the fiscal first half increased by more than 6%, and Nissan's rose by 2.8% right now. Honda down about 4%. Same for Nissan right now. And TikTok workers aren't happy. Sources tell the Wall Street Journal that the company is asking managers worldwide to give more employees lower ratings in performance reviews, and staffers fear that it's going to reduce bonuses and lead to some cutbacks. Revenue growth has been slumping amid regulatory scrutiny in the U.S. Those are the company's stories we're following. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets, the S&P 500 is up 0.6%. NASDAQ up about 0.75% off of their intraday highs, but still holding those gains. Yields a little bit higher here. The 10-year Treasury is up 6 basis points, 4.90 on your 10-year to the 3-year. I'm sorry, to 30 years, 5.07%. WTI crude oil off almost 3% today, sitting right at $83 per barrel. So big pullback in oil. Bitcoin pretty much steady here today, 34,600 on Bitcoin. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
Thank you, Paul. The new Speaker of the House says a standalone funding bill for Israel will go to the House floor this week. Louisiana Republican Mike Johnson says he called on President Biden to separate bills to provide aid for Israel and Ukraine when he met with him this week. The Biden administration is proposing a combined $100 billion aid package, including both Israel and Ukraine. General Motors and the United Auto Workers Union have reached a tentative contract agreement that could end a 6-week-old strike against Detroit automakers. More on this now with Bloomberg's Kaylee Lines in Washington.
The wage figure looks very similar to the agreement that the UAW, of course, first struck with Ford, that 25% increase in cost of living adjustments as well. What is unclear in GM's case specifically is what exactly the retirement benefits may look like, as that had been a sticking point why this of the big three automakers was one of the holdouts here. But what this likely will bring is an end to the strike.
The deal follows the pattern set with Ford last week and Jeep maker Stellantis over the weekend. Donald Trump will be spending a big chunk of this week in Texas attending fundraisers. Experts say he is using the Lone Star State like a personal piggy bank.
Texas has been fertile ground for conservative fundraisers all the way since Lyndon Johnson, because Texas has a lot of wealth, and that's conservative wealth mostly.
SMU political analyst Cal Jillison says the GOP frontrunner has a long political and fundraising operation in Texas. Donald Trump will be in Dallas on Wednesday and Houston on Thursday. Both events are private, and there are no public rallies planned. It may be weeks until the Los Angeles County Medical Examiner releases an official cause of death for Friends star Matthew Perry. Officials confirm an autopsy was completed on Sunday. There were no obvious signs of trauma or foul play. Matthew Perry was 54 years old. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. Boy, there are strikes, worker stoppages, strikes all over the place. Hollywood, Detroit, now looks like it's going to get fixed here.
Right
today.
here in New York City.
Right here in New York City. The New York Times Company, the technology workers there, they plan to mount a half-day strike Monday afternoon today, accusing the media company of trying to unilaterally force them back to the office without negotiating in good faith. So I guess if you're a union, you get the ability to negotiate these types of things. And New York Times is saying, no, everybody come on back to work.
Exactly. So they give us the detail, the breakdown of the vote. It was 404 to 88 last year to unionize with the News Guild. So giving those IT workers more organized power. The work stoppage is going to start at 1 p.m. today, according to that guild, and they'll be holding demonstrations. This is the best. So not only do they not want to come to work
I'm not even going to come
in the
in
office,
strike.
they're not going to come to strike. The strike will be held on Zoom, partially.
It's just, please.
You think they're going to pass out a dial-in number?
They can wear their Halloween costumes.
Yes, they can wear whatever they like. They don't even have to wear pants, frankly. But it's nearly 700 employees in this tech guild. They've agreed to participate in the strike. And I'm just worried that it's going to impact my New York Times app. Because
your app? Oh, yeah, sure.
I find it to be a fantastic place.
It is
to
a great app.
I can say this, right, without feeling like I'm a turncoat in any way.
No.
I
We have the
find
New
it a
York Times-
fantastic place to get breaking news.
And we have the New York Times content on Bloomberg, so our terminal users can get access to that, plus Dow Jones, plus pretty much every other journalistic organization. New York Times stock is up about 0.3% today, up 23% year to date. New York Times Company has a market cap about $6.6 billion. They have, as an analyst used to follow that stock, they've really created a pretty darn good digital business. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Ambassador Adam Arilli, principal at Ibero-American Consultants. He's going to join us to discuss the role of Qatar in the Israel-Hamas war. So we'll get his perspective, his informed perspective. Plus, Ed Harrison, senior editor for Bloomberg News, is going to discuss his piece on the parallels his season markets from 2006 to 2023. So we'll break that down. Now let's kick it all off this hour with a Bloomberg Business Flash. John Tucker.
All right, major averages are all higher, but they've paired some of the earlier gains after last week's decline confirmed a correction. S&P 500 this morning, it is up about 0.7%. The Facebook parent Meta Platforms leading gains in the beaten-down mega-cap space. And on the earnings front, the S&P 500 on track for 2.1% year-over-year earnings growth this third quarter. That's a surprise from the pre-season forecast for a decline. And, of course, on the calendar this week, busy calendar, Federal Reserve officials meet on interest rates tomorrow and Wednesday. Economists say the odds are against another rate hike this week. And it's getting increasingly difficult to figure out the path ahead for the economy. That's according to Francis Donald at Manulife Asset Management.
We've seen several Fed officials come out and tell us, hey, guess what? Those strong economic data points, they're not consistent with what we're seeing on the ground. And those single sentences that say the Fed is actually taking data with a grain of salt, that's what keeps me up at night.
Right now, the S&P 500, again, 28 points higher. That's a rise right now, 0.7%. 41.45 in the index. The Dow Jones Industrial Average is up 307 points. NASDAQ 100 up 109 points. And we had the 10-year yield 6 basis points higher, 489. And let me give you a quote on NYMEX crude. That is down over 3%, 3.3% decline, 82.74 a barrel for West Texas. And the boom in weight loss drugs like Ozempic and Wegovy has another Wall Street firm warning investors about the stock of Krispy Kreme donuts.
Really?
Yes. Truist Securities downgrading shares to hold from buy, cutting the price target to $13 from $20.
I get it. Because no matter how delicious the donuts are, don't say you're not a big fan of Krispy Kreme donuts.
I'm just not a donut person.
They are literally the best donuts.
Really?
That you can get at any chain I've ever tried, and I love donuts. But they're nowhere to be found. Where do you get Krispy Kreme donuts?
Penn Station, dude.
Okay, no one wants to go there.
Definitely no one.
Like, they should put one in a nice neighborhood. There's Dunkin' Donuts everywhere. And I'm going to say, at least